Since Nixon closed the gold window in 1971, you have a 93% correlation of total federal debt to the gold price, which is the highest correlation you're going to find. U.S. is now, basically up against the wall. Gold is going to go through an acceleration phase. I mean, I think it's starting that acceleration phase right now. Going along that line of logic, you'd say, okay, well, maybe we're going to stabilize somewhere in the 4,000 to 5,000 range for a while. You're going to have some type of gold link, in order to put the confidence back into the system. You own gold assets as a hedge against policy failure.
Why are billionaires buying gold, and why are they talking about it on mainstream media? I mean, did you expect that? We'll talk about that. I want to talk about what gold and silver stocks you are buying, Greg, and where do you see gold going over the next few decades? So we're going to be looking out long term. That's going to be the basis of our conversation today. But I'm sure we'll end up talking about a bunch of other stuff in the meantime as well. And for people listening, this episode of Real Money Talks also contains 2 CEO interviews in, of course, the CEO BBQ portion of it. So I'll be looking at the newest gold belt of British Columbia with Westhaven Gold. And I'll be looking at one of the highest grade historically producing gold mines in Canada, which is in a district that's produced over 25 million ounces of gold over a period of over 100 years now. And I'm going to be talking to Radisson Mining. And of course, there are timestamps in the description of the video, in the comments, on the time bar, and even on your screen right now. So please use those to navigate the video if that makes your life easier. As I move into my first question here for you, Greg. And first of all, thank you for being here. Of course, I know you're a busy man, though, and I don't want to waste your time in pleasantries, if you will. So I'll just give a brief synopsis, if you will, of who you are. Essentially, you're a precious metals fund manager who's managed the OCM Gold Fund for about as long as I've been on this planet for. And you've done well in the meantime. You've been outperforming the benchmark in some of those years, which is something we'll talk about later as well, your performance. But let's kick it off with kind of high level, because actually, since you've been managing the fund and since I've been on this planet, gold has outperformed all 3 of the main U.S. indices, and that's specifically over the last 25 years, by a significant margin, without carrying counterparty risk or any other risks that are involved with investing in individual stocks or even the indices, right? Making the risk-adjusted return, even when you account for dividends on the indices, it makes it even more impressive for gold when it's risk adjusted. So what do you ascribe that to? Why has gold performed so strongly over the last 25 years?
Well, you're really kicking off a period of, when Alan Greenspan was the Fed chairman. He really started the move towards extraordinary monetary policies, which, as you got into more aggressive efforts to make sure that you didn't have deflationary forces, the Fed became more aggressive in printing money. And as you started to expand out the extraordinary policies, you had the kind of post .com era, especially when it picked up the most. Because if you look back, probably the 97 to 2000 period was probably one of the dark times when the Bank of England was selling off their gold. And there was a big push at that time to really make sure you're talking about King Dollar, and the U.S. was promoting the dollar as the asset for all nations to use. And at that point, you got into a period where central banks were selling off all their gold, and that's when sentiment towards gold became extremely negative across all, basically for investors. Why do I need it? The central banks are selling it, and so post .com era, I mean, that was the sentiment. Also coincide with the last Nasdaq.com boom, and when that broke, sentiment started to shift. People become a bit more defensive, and then you had the 9/11 2001, and the expansion of government, putting the Homeland Security in, the budget deficit really started to expand quite a bit at that point, and that's when you started to see this exponential rise. I mean, you'd had a exponential rise, large rise in total federal debt outstanding, but um, it really started to accelerate kind of post 2001. And there is since Nixon closed the gold window in 1971, you have a 93% correlation of total federal debt to the gold price, which is the highest correlation you're going to find. And everybody wants to look at and say, oh, well, the dollar index, if the gold price, is inversely related to the dollar index. And if you put up a dollar index versus the gold price over the last 50 years, what you'll see is the dollar index looks basically like a dead, patient, going across, and where you have the gold price going straight up, over that period on a relative basis, over the last 50 years. You've gone from $35 to, you're 27, 30 here as we were speaking. And as that is really just a basis of the debasement of currency. And, the dollar index is a index of versus one paper currency versus the other, which are all competing against each other to from export purposes. So they'll continue to have a competitive devaluation, and so they're all devaluing ultimately against gold. So that's, I mean, why is gold really moved over the last since 2001 to 2010. That's when the extraordinary policies really took off in terms of finding their way into the marketplace, in terms of the psyche of investors. And at that point, 2008, they got even more aggressive post the GFC. So things have not slowed down in terms of total federal debt outstanding, and it's just continued to go up. And the U.S. is now basically up against the wall, and fiscal positioning of where the U.S. is, and basically all countries out there, they have gotten to the point where they feel that they can basically issue as much as they want without repercussions in terms of their currency. So, and that's starting to show up in the gold price. Not everybody believes it, because they have been conditioned to believe that the gold price, I mean the gold market, is not something that they need. They don't need that protection because the stock market's been going up the whole time, and gold tends to be very sentiment driven for investors. And as the market's going higher, you have people view owning gold assets as, there's an opportunity cost there. And so as that opportunity, cost starts to, go away by the gold price going higher, you start to attract, more investors. We haven't seen Western investors really come into the gold space, in this move over the last couple of years. What you've seen is, the central banks have been buyers, and, as real rates were going up, everyone was questioning, well, the gold price shouldn't be going up because real rates are going higher. And, at the point that, people start to realize that there's something else out there, what that is, I don't know. I mean, clearly, post the, freezing of the Russian assets, what you saw was a big move by central banks to increase their gold holdings. And so things have changed. The landscape has changed quite a bit, out there on a international basis. So.
You're touching up on loads of important stuff there to talk about: fiscal policy, monetary policy, geological. I'm thinking too much about geology. Geopolitical upheaval. And we'll talk about all that. It's interesting, just an hour before we started talking here, Greg, there was an article on CNBC talking or highlighting what Paul Tudor Jones had said. And he said, and I quote, "All roads lead to inflation. I'm long gold. I'm long Bitcoin. I own zero fixed income. the playbook to get out of this debt problem is that you inflate your way out, unquote. That's what he says. And so that's kind of strong. I mean, people are starting to wake up on it. And, oftentimes in these conversations, it goes back to talking about where gold might be headed by the end of this year. And feel free to tell me it's going to $10,000, by the way, because that's going to get me a bunch of views on YouTube. But I want to take the longer time frame here, maybe, and the larger outlook, if you will. What do you think about the next 25 years? I mean, we're getting these kind of articles here. Larger fund managers, larger, smarter money, if you will, is waking up to the fact. So what's the next 25 years going to look like? Is it going to be just as good for gold, maybe even better, or who knows, maybe even worse? What do you think?
Well, gold is going to go through an acceleration phase. I mean, I think it's starting that acceleration phase right now. And similar to what happened in the late 70s, when gold really started to take off. You went from $400 base to $800 very quickly, and then you pull back and then stabilize in that $400 range. That has been the move that started at $35. And so, what I think is going to happen, and you're going to reach a point where the U.S. is going to have to make a decision, as a reserve currency, that you either have to have fiscal discipline or you're going to have a new monetary system at some point. I believe that a new monetary system is coming, and you're not going to be able to, with the level of debt that you have out there right now, you can't allow interest rates to go to 10, 20, 30%. I mean, this all becomes Banana Republic stuff. And so what do you have to do in order to try to thwart that move higher? At some point, you're going to have some type of gold link, in order to put the confidence back into the system. And what gold represents from a monetary standpoint is discipline. And discipline is not something that politicians really like. And so, in order to really meet all their promises, what's the best way to do it is to inflate it. And, what Paul Tudor Jones is talking about is, trying to meet those obligations through inflation, just because there's no political will, especially in the current environment with the Democrats and the Republicans, you can't get anything done. And so what we're really looking at here is, what trying to cut off, a total implosion at the pass. And how do you cut off a total implosion at the pass? Is you've got to put confidence into the system, and putting confidence into the system is going to involve gold. And what we're seeing, with other central banks buying gold, especially in the East, is, are they sensing that? Are they going to make that move first to try to, have a reserve currency that, one-ups the dollar? And, looking at, you can look at the balance sheet of the U.S. and, it becomes worrisome, based on future obligations. How are you going to meet these obligations if you, cannot, control interest rates, without the deficit going, from 36 trillion to 100 trillion, and 100 trillion, you talk 25 years, at the exponential rate that you're going, I mean, you will be at 400 trillion, just throwing a number out there, of total federal debt outstanding. Well, the gold price is going to go up, quite a bit if that's the case. And we're not really talking about, an ounce of gold is still going to be an ounce of gold. Just we're just talking about, what is, we're trying to use the dollar as a measuring stick, but they're debasing the dollar. And with what the big effort that needs to be put in place by policymakers is to try to put a discipline in place, so there's confidence in the marketplace that there's going to be stability in the dollar and paper currencies. But they're all out there and looking to debase their currencies. They're even at a 2% inflation rate. I mean, as the target, that is a level of debasement that shouldn't be allowed anyway. I mean, you should be at zero. Yeah, I mean that should be the target, not 2%, but that's not the case.
Hmm. That's a larger topic in and of itself, I think, Greg. And my good friend Lobo Tigre calls it the dollar gold exchange ratio, and not the price of gold, to put it that way. But you're right. I mean, since and I've got a bit of data here from another post that I found on Twitter. It's coming from Bloomberg and the World Gold Council. It's collected together by Canaccord Genuity. And so they note on here that since the US cut the link between gold and the dollar in 1971, what we've seen happening was the US money supply increasing by 33 times. US federal debt has increased 87 times. US federal debt rose at 1.5% per year between 1945 and 1971. But then on the back of that, so since 71 till now, it's got an almost 9% CAGR. So we go from 1.5% growth to 9% growth in US federal debt, which is what you were just talking about. Gold supply has increased by 2.3 times in the meantime, so significantly lower CAGR, 1.6%. And the gold price, or the gold dollar exchange ratio, has gone up 71 times. So correlation is not causation. I know I'm going to get lynched for that in the comments if I don't say it, but it's true. I mean, that's exactly what's happening. And so this is where I kind of want to take the conversation, because what do you think? And those are a couple of different things that we're talking about here, really, that all paths seem to lead to money printing, which is essentially inflation, which is essentially what Tudor Jones is saying. So, but what's really going to be the main driver here? I mean, is it going to be fiscal policy, or is it going to be monetary policy, geopolitical upheaval? What's really going to drive gold demand, and how predictable do you think it is from here on out?
See, I think it's all three. And I think when people ask me, why do you own gold assets? I said, you own gold assets as a hedge against policy failure. And you're in the middle of fiscal policy failure, you're in the middle of monetary policy failure, and you're also having foreign policy failure. And so it's all three. And so where we are right now is, how do you get your arms around all three of these issues? And can you look at the current candidates for president and say, okay, are they going to solve it? And you probably say no. And can the Republicans and the Democrats come together on anything? In the House and the Senate at this point, there's a lot of divisiveness that's there, and so at what point do we get to where they can come together and be rational to move the country forward? And usually that only happens in a crisis. And so is that crisis going to be a monetary situation? Another 2008 scenario. And if 2008 scenario happens with all the debt that's out there, do you come to just more money printing? And as Bernanke famously quoted is, we don't worry about deflation because we have the printing press. And then Jim Grant turned around and says, well, if it's so easily reproduced, what is it worth? And so that's where we're at going forward is, how do we solve the issues on the table? And the gold price, putting a number on the gold price, I think is pretty ridiculous, going forward, because it could go to anything. When I first got in the business in 83, there was a guy, Robert Prechter, who was doing the Elliott wave, and the Dow was around 800 or so, and he was talking about the Dow going to 3,000. And I was, oh God, he's crazy. The 3,000 absolutely sounded like a crazy number. And sure, obviously you went to 3,000 and kept on going. And so a gold price, we're going to get down to what is relative value, and that's when people start to get into, okay, the S&P to gold ratio, or the Dow gold ratio, and do you get back to 1-to-1, and like you have in history, and where financial assets then become cheap versus gold. And so that's going to be what kind of the numbers that you start to look at is what are relative values.
Hmm. What do you this is kind of a crystal ball question, but what is a good value for gold right now? Like if you turned on your screen and all of a sudden gold was, I don't know, revalued or something like that, what kind of number would make you go like, yeah, that makes sense?
Oh, I mean, what number makes sense is, I think, uh, it depends on if you're going to officially revalue it, you're going to have to put it up to some number that um, seems absolutely crazy, and that probably is a is it an $8,000 to $10,000 number
Hmm.
that you know probably and the reason why it's maybe 8,000 is not so crazy if you really think about the how the gold price has moved over time and how currencies move over time. You're adding zeros. The Zimbabwe's doing currency, adding numbers to their currency. They're adding zeros all the time. And so, if you look at $35 gold and then you say, okay, well, let's add a zero to that, well, you get to 350. And that ended up kind of being a stabilizing area for a long time, 350 to 400. And so you add another zero to that, you get to 3,500 to 4,000. And you double that up, and next thing you know, you're at 8,000. And so if at the top of in the high in the 1980 was 800, you can say, okay, 8,000 was a number that you got to the peak. Going along that line of logic, you'd say, okay, well, maybe we're going to stabilize somewhere in the 4,000 to 5,000 range for a while.
Hmm. What happens to silver in that case? I mean, it's another double-edged sword, monetary metal, but also an industrial metal, supposedly for a large part. So, what happens to silver in that case?
Silver's, silver's gonna. I'm bullish silver, so I think silver is, it's a, gonna go to a number that's, probably a couple $100s, and people might say that's kind of crazy, but it's poor man's gold, and you know, so a couple $100s is, the peak. But last time around was $50 on this last cycle in the 2000s. I think you'll get there. You know, that'll be a stopping point before you go higher. But a multiple from there, to take it to a couple hundred, you start to get some frenzy. I mean, you have to realize we have no buying, no sentiment interest right now in the precious metal space in the West. This demand that has been there has come from the East and other areas, but it hasn't come from the West. I mean, we have seen the large gold bullion ETFs have all been net sellers on the year. If you take the precious metals equity ETFs, the big ones, the GDX and GDXJ, they have fewer shares outstanding today than they did at the beginning of the year. So that means there's been net selling there. So we have a lot of non-believers. I mean, what does it take to get a turn? And that's what I get asked all the time. What's going to change sentiment? And um, sentiment changes um, by either the broader equity markets rolling over or some other event that takes place, whether it's a outside force, geopolitical event, some type of monetary event. Um, that changes sentiment. I sense we're starting to get a bit of a turn. I can feel it from some of the calls that I'm getting right now that we're starting to get some turn, um, but it's nothing like I've seen in some other cycles.
Hmm.
So we're not we're not we don't have a lot of enthusiasm, and you can tell by if you go to just the how the stocks are acting. There's the small stocks, the exploration companies, and those which tend to get a lot of speculative capital. They're not seeing much movement at all right now. So
Most of my stuff are not seeing a lot of movement right now, unfortunately. So that kind of pisses me off, but it is what it is. I suppose it's interesting though, Greg, that you must be one of the very few surviving gold managers though over that whole period, right? It makes sense for professional money managers, I guess, to a certain extent to have focused on tech stocks and whatnot in the meantime. But do you expect that to start changing now that gold's outperformance is becoming so apparent and that you see this strong future for silver? I mean, do you expect the way we've seen the number of gold precious metals fund managers and funds kind of dwindle over the last 25 years? Do you expect us to see that number grow over the next 25 years?
You'll see some new funds start. Yeah, what the level of, I mean, there'll be private funds that start, um, try to take advantage of opportunities. You'll see, in terms of mutual funds, ETFs, I doubt you'll see any, more mutual funds. You'll maybe see a couple more ETFs, but, the space is pretty well, serviced by what is already out there. What you have to have happen is money needs to come back into the funds. I mean, I think we're at a even now, based on where the size of the mutual funds were and the funds and the major ETFs based on the 2011 peak of the last cycle. I mean, you're down at least in half right now in terms of assets under management.
Mm.
So, so that's a that tells you that the capital flows haven't started here. And at the same time, I mean, you've had tremendous money printing that's taken place, and you've had explosion of market caps of on the broader equity markets, and that speaks again to that what I said before was opportunity costs. I mean, people have been their imaginations are captured by what's going on in tech, and tech represents growth. And historically, miners, are a gold asset, and people buy them for defensive purposes historically, and that's that sentiment move. And what you're going to see is at some point, if the market rolls over, and there's not a large, there is a large segment of the market that hasn't been moving, and but the tech still has captured, especially AI has captured the imagination, and there's been growth of earnings there on on the tech stocks, though Apple has slowed and some of the others. Um, but the miners will start to screen extremely well as you've seen sequentially higher average gold prices, quarter over quarter. And so you start to get that increased, cash flow. You'll start to get, more interest from a screening standpoint by generalists that will say, okay, what's going on here? And so it'll go the miners, which some believed was an uninvestable space, will go to, okay, well, they have their act together and they're making money, and
Hmm.
there's stronger capital allocation, et cetera, that's going on. So that starts to attract more capital to space, and you could blow out this space quite a bit. I have historically said that at some point it'll be like Niagara Falls trying to get through a garden hose. There'll be a rush of capital that will want to come into the space, and you'll be trying to feed it into a very limited number of companies,
Hmm.
and that will blow out the capitals, the market caps of the companies, and because you make room for investors by having an incredible rise in market capitalization, and you can see that with Nvidia. I mean, that's a case of making room for everybody who wants to get in, and so they people were knocking on the door, and this share price just keeps going up,
Hmm.
and we'll give you room.
Yeah.
So
I believe it's Doug Casey who kind of has a similar saying. He says the contents of the Hoover Dam through a garden hose or something like that. I think he's gone as far as to say through a paper straw or something like that. So it seems like it's going to be an interesting time for the equities ahead, and that's something I also want to talk about here in a couple of minutes. How have capital inflows and redemptions been for you over the last 25 years, though? Because, and let me tell you where I'm coming from with this, because there's an outperformance of gold here, yet we're at historically low levels of ownership, right? I mean, you look at all these surveys. I don't have an exact number in front of me, but I see them every week. Fund managers own, just 1.5% or whatever of their portfolio is in gold. Basically, nobody owns gold. You watch all these videos of people going on the street and asking people, if you could guess the value of this coin, I'll give it to you. And no one even wants to take it for free, but it's a, 1 ounce gold coin or whatever. And so nobody seems to care about gold, yet gold is outperforming. So how's that been for you and your investors and capital inflows and outflows?
Um, it's interesting that during COVID we saw good inflows, but over the last couple of years, all that money really left, and you could see that the same thing that happened in GLD. Previous to that, when I took over the fund, we had, in '97 there was $1 million in the fund. We took it to 250 million. And to give you an idea of what happens, in a bear market cycle, kind of post 2013, this happened to a lot of the funds. At its low, you went back down to basically 10% of that high of 250 million on that fund. And so we're starting to see some inflows now. Part of that is that we've been near the top of the performance rankings, so we're seeing inflows there. But I have noticed that as a space overall, there hadn't been any real inflows into the any of the other mutual funds to speak of. They'd actually seen outflows, and so that just speaks to lack of Western sentiment and excitement in the space. People still looking at it. Maybe they got in previously. Oh gosh, it's up. Get me out.
Mm,
I think there's some of that taking place too.
mm. What about the other precious metals that are maybe non-monetary? Not maybe, they are non-monetary precious metals, platinum, palladium. Is that something you've typically focused on over that period, or is it something that you kind of have left alone?
I've left it alone, and the reason why is that I'm a real firm believer in um, gold as a monetary asset, and so I believe that people should be looking to our fund to hedge those, what I believe are those policy failures and the monetary risks that are out there. And as much as obviously, miners are, we only deal in the miners, and therefore, it's kind of a viewed as gold in the ground. Um, but I view that that's the hedge that we're providing for investors. So, I really stick to, providing, from a monetary standpoint, gold and silver assets. But yeah, I've never really owned a maybe once or twice a platinum miner in
Mm,
the fund.
mm.
Yeah.
Yeah. No, it's understandable. I mean, if that's your strategy, that is your strategy. And let's maybe, put the gold macro to the side here for a second. I wish I was smart enough or patient enough to just buy and hold physical gold, but knowing myself, I know I'll overcomplicate the strategy and try to, again, leverage to gold with the equities. And more specifically, in my case, it's typically the non-revenue generating companies, that being the explorers and developers. But even the revenue generating companies haven't done as well as the physical metal over the last 25 years, and rightfully so. I mean, they've been, let's be fair, bad businesses, and cash flow margins have not performed as well as they could have with the rising gold price. Yet your fund has done decently over that period. Why is that? Or simply put, why do gold miners suck, and how have you unsucked them in your portfolio?
Okay. So, what did we see in the last cycle is we saw companies that had to unwind hedges. They got kind of enamored with hedging strategy. Barrick was obviously the king of that. The Australians were very big, and hedging strategies have historically um, not worked. I mean, they've basically hedged against uh, you know making money. So, we talked about early on how the gold price has gone up over the last 25 years and the last 50 years. And so if you were to hedge, you really should be looking at, okay, I could hedge, 3 months out or 6 months out. A lot of mining companies have always used the argument that I'll hedge because we have a big capital program and we can't go back, over the next, while we're paying back that capital, we can't afford to go backwards for, the next 24 months. Well, I can appreciate that. But, going further out and hedging, a lot of production just for the sake of hedging it doesn't make a whole lot of sense for me. And companies like Barrick, Anglo, and others, had to issue stock in order to pay off those hedges. You know, and on the last cycle, you had bad M&A transactions, which were kind of a leftover from previous thinking, which was, gold shares were an optionality, and the valuations. I just need to get bigger, and so we can have that optionality in the share price, and that's how our shares will trade. Well, as you brought in, the bullion ETFs, you started to have a competitor, and people, could get exposure to gold through, a gold bullion ETF versus, the miners, which were, really had a monopoly on it for a long time, and so, the valuations changed, and so, you've had to have a restructuring of the thinking, in the marketplace, um, by the miners and the management in terms of capital allocation and share issuance, being able to make sure that investors participate in the cash flow. I mean, when you're dealing in a resource company, you are dealing with a depleting asset. And one of the things that a lot of mining companies failed to recognize was the level of returns on capital that they needed in order to really fit you know everything into basically the three buckets, which is, you got to return the, you got to, pay back the capital cost to build a mine. You need to have enough money to sustain the business going forward and grow the business for the next mine and explore. And then you need to be able to, return capital to shareholders. So there's basically three major buckets there that you need. And so in order to do that, you can't have on a 10-year mine life, a 10% return, 12% return, especially for how long it takes to build a mine from discovery, and take it all the way through from discovery to permitting and capital to build it. I mean, those returns need to be much higher, and that's part of the barriers to entry in the space is that you have you just have to have a much higher hurdle rate, for the mining companies to build a mine, and there's a very few right now. The scarcity of deposits has only become greater, over the last 20 years. I mean, it's if I look back and when I first got in the business in '83, the gold price had made the run, and heap leaching had just come in, and the railroad companies had checkerboard land positions throughout Nevada, and they were they got involved in heap leaching, and it was and they were making discoveries out in Nevada, and the gold mining business was a growth business at that point because it had been able to build these mines that they hadn't been able to build before with heap leaching, and the fact that there was margin there, with $400 gold price versus gold prices had been in the 70s and the hundreds. $100 or $150. And so, it brought in, that more capital that said, how long has this been going on type of thing. And, so, you had a big growth spurt, in precious metals mining that took place. And now, if the gold price is, $2,700 and starts to hold, 3,000 and plus, the you know, do we bring in a new technology, or is it just the fact that we're going to have a $3,000 gold? We're going to have good returns if we can keep the costs down, and if we can keep the costs down and capital allocation discipline, we will be, we'll attract, more investors that will, then be able to get the share prices higher. And, to answer your question about, okay, the overall group hasn't returned well, I think we have to look at, that has to do with, you know, yeah, it is a depleting business and it's a tough business. And miners have had to do M&A, the ones that have been around for a long time, and so they end up having more shares outstanding, but maybe the same amount of production, and so you don't really go anywhere. You can look back and look at how many mergers and acquisitions that Newmont has done, going back to Normandy and Gold Corp and Newcrest, all these ones that they've done here even of late. And the production had gone up to 8 million ounces and back down to 4, up to 8, back to 4. And now they're only looking at, okay, well, we got tier one assets only in 500,000 ounces plus. Well, there aren't that many of those. And so, but you sell off everything that's smaller than that, under 500,000 ounces, but you still have the number of shares outstanding unless you are out there buying back a lot of stock. They are buying back stock, but it shows that that's a tough way to grow the business. On a sustainable long-term basis, is to keep on buying companies and then selling off or letting the mines deplete and going back to the previous level of production. So I'm when I look at where the success has been for us over time, it's been finding the Randgolds earlier on, finding Gold Corp early on, and getting with basically smaller companies in the intermediate and junior space, and then letting those grow and getting with management that understands it. And that's the challenge right now is okay, who's the next real strong CEO, or somebody with a vision that's going to be able to grow a company and then has the deposit to do that. I mean, it's scarce. It's not an easy business from that standpoint, and that's the challenge that sitting in my seat right now is okay, finding the next real all-star CEO that can grow a business without blowing up along the way.
That's exactly where I want to take this, Greg, because I'm thinking, what's going to matter? What's going to matter during this cycle? And is it going to be the same as last time? And I actually suspect different segments of the mining business will perform differently during different parts of the cycle. But so looking at how gold has performed this year so far, what segment is it? The explorers, the developers, the producers, the royalties, the picks and shovels plays, if you will, or is it something else entirely that you think will outperform over the upcoming, next part of the cycle, if you want to call it that?
Okay. So, I mean, a lot of people have been bemoaning, I'll get to your question here, but a lot of people have been bemoaning the fact that, the miners haven't done anything. It depends on which miners you're in. Some miners have done extremely well. And so, has Barrick done nothing? Yeah, no, it hasn't done anything of any consequence. And, you could say that, them, focusing on copper has, and, same bit with Newmont, and the larger ones, making that move to having more emphasis on copper as being a real detriment to their share price performance. But if you look at how is um, stocks like Alamos done, they've done well. And there's been some of the West Africans that have not done well from a geopolitical standpoint. They've kind of have underperformed, whether it's a B2 Gold or Endeavor, because of the perceived and real, I guess, geopolitical risk in the region. And so capital hasn't gone there. We've seen some strong moves on some of the silver names, Aya Gold and silver. Hawk Shields come off the bottom. Some of these companies have had some a very good performance over the last 12 months. And so what it really comes down to is you do have to do stock picking. And that's why in my opinion that you do have to understand the business. And so where are we going next? I mean, where are the big winners going to be? um, and this kind of has always gone to my philosophy that the way you structure a portfolio in the precious metals equity space is you do have the majors in there because they provide the liquidity, and if the large institutions come, the share prices, shares of those are going to go. And then you have the intermediates because they can grow. The junior producers, they can provide leverage and growth. Then you have the royalties, and they're pretty much more of a defensive play. They, if in a bull market, they're not going to perform as well, and that's you've seen that here. Is the royalties haven't done that well on a relative basis. They can be viewed as expensive, and it depends on how you want to value them. And but then you get into the exploration and development companies, and what I think is has really lagged here has been the development companies. You know, and those will provide the pipeline for the intermediates and the majors. We've seen some M&A take place here of late. Um, you know, Goldfields buying Osisko Mining, and then G Mining on the reunion. Wouldn't surprise me to see somebody take out G Mining on trying to get a um, at some point down the road. I wouldn't be surprised. Because there aren't that many 5-10 million ounce deposits out there. They're scarce. And so what this market really um, is looking for is real strong development assets that can be permitted, and time. It's where it's not going to take 20 years to get it permitted. And one of the things that is really undervalued in this space is time. Um, time is time and capital can create opportunities. If you look at buying something where a lot of time has gone by, a lot of capital's gone into it, and you're starting to reach an inflection point to where that can be re-rated. And you go through cycles in resource business, and especially in the gold business, where the capital flows and the money can go into the ground, and then it dries up, and then the opportunity is to before the capital starts coming in, is finding those companies that where capital was spent before to where it can get re-rated again. It depends. The project has to be of merit. I mean, there are certainly a lot of moose pasture type of companies out there. And when you get into a real bull market, people will, have some mag survey, and next thing you know, they'll say, "Oh, Jesus, this is wonderful," and it's valued at 40, 50, $100 million just on, capturing someone's imagination that they might make a discovery. And so, that's what you have to be careful about. I mean, Julian Baring, who managed the what the predecessor to the BlackRock Gold Fund was a and Merrill Lynch Gold & General Fund out of London, which was the biggest fund. As he famously said, he would sit back there and at the Denver Gold Forum back in the early days, and someone would be talking about some company, and I mean their company, and he's sit there and say, "Well, that sounds like a lobster pot to me," so meaning that you get in but you can't get out. It'll be a slow boil to death, and um, you can get caught in this space quite easily.
Mm.
So you have to be careful of that the projects that you get in or understanding why you're getting into certain exploration and development, that there's risk involved in those, and that very few of them, especially exploration plays, and even a lot of development assets, even if they have some resources, very few become mines. I mean, everything has to line up. And so I think um, we are looking at assets, right now, development assets that, have had capital spent, are further down the uh, permitting line, is representing the best value right here. So, and that's where I see the M&A will, be for, for especially for the intermediates looking for, fill their pipeline.
What
So
is a good capital allocation strategy, in your opinion, for the majors or the perpetrators, if you will, of M&A? What should majors be looking to buy now? And by extension, what should I be looking to buy now if I want to get, kind of want to front run a feeding frenzy in M&A?
I think you should be looking to buy development assets. You search out development assets that have a have had, like I said, have had that time and the dollars spent in the ground where a lot of drilling has taken place, and now the stocks are it's trading for a fraction of that capital that was put in, and there was good results. So you have to go out and search for those, and that's what I'm doing, kind of constantly, and a lot of things will you look at, you have to look at the people that are involved. I mean, have they done it before? And if they haven't done it before, that's going to be, they're probably going to have to go through a learning curve. But you do have to find people that have done it before and have shown that they can create value in the space. So I mean that's what you need to look for. I mean one of the mistakes that people make if you start to get into a bull market and capital comes in, is their imagination does start to um, you know get uh, captured by pure exploration plays. And pure exploration plays are not, they call them junior miners, but they're not miners. And they are what they are. They're exploration plays. People get disappointed when the gold price starts to move, and their exploration company's not going up.
Mm.
And they have to really appreciate that they have an exploration company that needs to make a discovery in order to get that jump. And um, so without the discovery, I mean, you're just trying to really hope that somebody else comes in behind you to give you a way out. And so you have to you have to definitely look for, if you want to be in the mining space and you want leverage to the gold price, that's going to be either a company that has proven resources in the ground, so there's actually an increase in the value of the in-ground value, or companies with production where you're going to have that operating leverage, and then you're going to get increases in cash flow. And
Well,
so
what are you getting in right now? Any specific names that you can give me, or like what are you liking on that front?
um okay, so um we have um been taking some positions, and I still believe that there's opportunities and value in the producers right here. I think you can, even though they've gone up a little bit. I mean, there's you can look at the larger producers and intermediates, and see that there's value there. And I would say that you shouldn't look away from from buying production right here. I mean, I still think that's cheap. I mean, but if you're looking for small names, I mean, you can look at um, you know thinking of some of the ones that we have in our portfolio that like, Rio 2, which is just announced a financing today, or last night, where they completed it with Wheaton and a marketed deal where they raised, $50 million, and plus, the Wheaton's going to do a stream for $120 million, on their project down in Chile. I mean, they had some, they were all ready to go, and then they got to the point where they didn't get their permits in Chile, and so now I think they got the permits now. They're all ready to go. So I look at it as a company that's on the doorstep, and you're looking for those inflection points. So okay, that's an inflection point. Could somebody else come in and want to buy it out also, to fill um, their production profile? So that's certainly possible.
Hmm.
So there's one name for you.
What else? You don't only have one name, I think.
Uh, um, what else? Yeah, in terms on the junior space,
Sure.
um, yeah, another one that recently, we bought into, and here's a case of capital spent. They got into trouble, um, and where I think I see the opportunity is, there's a company called um, Signal Gold that they just raised money for, and they're merging with Next Gold, which is it used to be Treasury Metals, which also has a known deposit. But Signal Gold is close to the path of getting their permits for production. Goliath already had over 1 million+ ounces on their own account. I mean, Next Gold, and so you have a couple million ounces of reserves. The Next Gold had traded down to basically nothing because they had taken out a loan with the Bari, and that was coming due, and the capital markets did not cooperate. So they had to do something, and so they got into a tough position. But that's a company that will re-rate, in my opinion, over this next 12 to 24 months. The market will start to appreciate the ounces in the ground, and that they have a pathway to uh, production, and that they have people behind it that kind of been there, done that type of
Hmm.
thing. So
Is there something you like on the silver front too? Because it's harder to get pure play silver exposure these days. So how are you exposing yourself to your bullish view on silver?
what one company that we've done very well on is Aya Gold and Silver, and out of Morocco, and it's a Canadian company run by Benoit LaSalle, who ran Semifo. And so that is a big position for us. We still like it. Um, we are in the midst, and I can't give you any names just because I'm in the middle of adding to a position, so I can't release that. But yeah, there are companies. I'm Mexico is obviously where there's opportunities in silver. One of the things that you have to still worry about is what's geopolitical situation in Mexico, and so, but that's also where the silver is.
Hmm.
There's a fair amount of it. So when you look at kind of pure silver producers, there really aren't that many, are there?
Hmm.
So
Oh, you're
Um,
right. Definitely aren't all that many. How many positions do you typically hold in a portfolio at once?
um, yeah, we go between 40 to 50.
That's a lot. How do you keep track of all that?
It's actually, um, yeah, it's actually a little easier than because if you're on it and have been doing this as long as I have, um, you know, uh, you just have to, kind of stay on top of it, and then, you're just looking for changes, things that change. Um, so yeah, we can certainly manage that.
Hmm.
You have certain core positions that haven't uh, yeah, where have calls with management a couple times a year, and um, you know, or meet with them.
Hmm.
So I mean, you can do 40 to 50 is a manageable number. You start to get to kind of above that 50 number, then it does become difficult.
Hmm.
But yeah, 50, 50 is the kind of my where I think I can't do as well of a job. But
Hmm.
yeah, it comes down to when you're putting a portfolio together, especially in this space, it comes down to position sizing. If you like something, or are you going to, you know, how are you going to position it? Are you going to buy enough of it? And one of the things that I keep telling myself right here is that bear markets teach you how not to make money in bull markets, and because you really um, you know, the bear market makes you fearful, right? Of oh well, this is going to go back down, and this didn't work, and the Stanley Druckenmiller, he made the comment that he doesn't like people with scar tissue because they won't be aggressive enough, and um, they invest too, they're afraid, and there's a lot of pitfalls in this business. I just think you do need to look over your shoulder. So we are. Um, but I do have to tell myself, repeatedly that, if you believe it's a bull market, you've got to invest for a bull market.
Hmm.
And and in my opinion, the gold price is broken out, and it's going to attract, you know, more capital, and that's going to expand out these market capitalizations for, something that looks expensive now, will not look expensive in the future. And I also believe that, we're going to see a change in how people value the gold miners.
Hmm.
Um, and there's two ways of looking at that. One is you're going to get you know, you know appreciation for gold ounces in the ground. Another is the banks historically have all gone to you know NAV calculations
Yeah.
for miners. And so, you look, oh, well, it's, things are trading for, 2 times NAV. It's too expensive. Well, one of the things that, all the, analysts use is consensus gold price, which is all, if you look at consensus gold price, and if you did that for, the last 25 years, you'd see all the banks, all the brokers have all historically not used a forward curve, and the gold price, all they do, they look at, okay, the gold price is right now, um, say $2,700. You won't find any analyst that had $2,700 gold price in their forecasts at any of the banks or brokers. And so if they moved it up now, what would show is, okay, well, we have the gold price at $2,200, and we have it going down over the next 5 years to $1,800. So all of their models use a declining gold price, which, on a discounted cash flow and getting the NPV, then, all really undervalues what the projects are worth. And, then, also on, when they're doing, NPV calculations, it doesn't value anything, with longer life mines. I mean, most mines last longer than 10 years. So you're not getting value for, out past 10 years and long life mines. So, um, what I what I think is going to happen is there's going to be an appreciation for different valuation methods. I mean, whether you're going to go back to 10 times cash flow multiples for miners or producers, that may be a number that is probably you know going to be more appropriate, I think.
Hmm. It's recently made a post about this, or answered. I think I responded to a post on Twitter saying that price taking businesses, so like mining, but also cyclical businesses like mining, they typically look cheapest at the top of the cycle and the most expensive at the bottom of the cycle because of using those price assumptions on the commodity. So that's one point of it that you make a good point there. Um, what else though, Greg? I've already taken more time than what you had initially promised me, so I don't want to keep you all day. Thank you for doing this. But what am I forgetting to ask you? What do you think we should be talking about that I'm failing to bring up?
Well, I think that I've gone kind of all over the place, but um, yeah, I think it really comes down to you know a belief that I have is that each generation kind of relearns the appreciation for gold as a monetary asset, and I think we're going to see that again. You think of you said, okay, well, you weren't even around in '97. So think of everybody that's grown up in this market uh, right now. What do they know about gold? They don't know anything. They don't know anything about the miners. So you're going to have a re-education. And why does that, why do you get a re-education? And why do you get that reappreciation for gold as a monetary asset? It's because something else happens out there. I still don't know what I still believe that the gold price movement. I mean, we know that the central banks have been buying, um, but there's a bigger force out there. That the gold price has been telling us something else is out there. Um, and I have no idea what the post-election movement's going to be in the gold market. One of the things that you could say, okay, we'll both have fiscal policies that are going to continue to blow out the debt, and maybe that's what the gold market is saying. Um, but with uh, the last time when Trump won in 2016. I think you had a lot of people believe that, oh, okay, the gold's going to go up because Trump got in. Gold did. The initial reaction was a short covering rally where gold was up about $50, and then it turned around and went straight down. And then the stock market went up as the market believed that you were going to have less regulation, and that was going to be bullish for the economy. And certainly the stock market did extremely well because of that. And the market is at that point of you know, maybe anticipating that right now.
Hmm.
So, excuse me. So I think, we're gonna see, if, post-election, what type of reaction is going to be, from the U.S. election, what's going to be in store for the gold market. And I would tend to believe that, the gold market might have a reaction that night, either up or down, but probably it's going to be, we're going to get more of the same in terms of trajectory moving higher through the end of the year.
And that might actually be a good time to catch up again, Greg, kind of in the back of that, beginning of the new year. And of course, for people listening, please leave us the questions you'd like for Greg and I to get to in our next conversation again sometime next year. And if you're interested in learning more about Greg Orrell, or what and how he does it, head over to ocmgoldfund.com. It's probably on your screen right now. And you can read more about, everything that he does. And thank you, Greg, for doing this. I'll let you drop off now, though. I know you're a busy man, but I've also got a long trip to make all the way over to Canada to look at 2 gold projects and grill 2 CEOs in this week's CEO BBQ segment. But of course, not before my favorite part of every episode, and that is, of course, the disclaimer, right after which I will actually go into the CEO BBQ. But then there's a warning on your screen right now to begin with. You're technically obligated to read it, but you're really better off actually doing that. Pause the screen and read it, because this is not just some disclaimer. This is an actual warning that might help you not lose money, which is the norm and should be the expectation in this very tough sector. And that's part of it too, by the way. Money is part of it too. I'm here to make money. This channel is a business that sells content producing and publication services. So specifically, typically to companies. So there are companies paying for the production of these interviews. And Radisson Mining, the company we're going to hear from first here, they have paid for the production of their interview. Westhaven has not yet paid, but that doesn't mean they're not going to pay for content creation in the future, right? So you should look at this episode, or any other episode really, you should look at it as marketing. These companies are likely seeing their participation in this program as a chance to do some marketing. So start by understanding that's a fact, but also start by understanding that most company communications online, albeit this interview, albeit their presentation, Twitter accounts, their Facebook accounts, LinkedIn, websites, news releases, all of that is marketing. And although I don't make buy or sell recommendations because there is a clear conflict of interest, many out there will do. Many out there will take money from companies and turn around and tell you, oh, this is the next best thing since sliced bread, right? And you should be aware of that inherent bias. It is your responsibility to look out for yourself and your own money. Nobody else is going to do that for you. So take your responsibility, be a grown person, and pay attention to that. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching or consuming any type of company-specific content, listening, reading, whatever it might be, just approach it with a dose of skepticism and treat it as the marketing that it is, because that is what company communications are. Unfortunately, I'm not a magician. The guests here are not psychics. Neither are the CEOs. So we don't possess any superior knowledge about what's going to happen in the future. Nobody knows what's going to go up, what's going to go down, or what's going to go in circles. And unfortunately, try as I may, I'm not going to be perfect. I call this show the CEO BBQ because it is meant to grill the CEOs and ask them tough questions, ask them literally everything that everyone out there is afraid to ask because they think they might lose clients. I'm not, but I won't always catch all red flags. Again, I'm try as I may, I'm not going to be perfect. I'm not going to catch all challenges with the company or all shenanigans or whatever it may be, right? So, and matter of fact, I still have no idea what I'm doing. I don't have a track record that you could trust. So this is all to say that you shouldn't blindly trust me, or for that matter, anybody on the internet. And you should do your own research. And if you don't understand it, don't do it. In addition, no guarantees are going to be made here, besides that there will be forward-looking statements in these conversations. These are conversations that are general and impersonal in nature, and they're going to contain hopes for future events that may or may not take place, depending on many different factors, both within and outside of the company's control. Be aware of that. Be aware of the inherent risk to investing and the increased risk of investing in non-revenue generating companies. And please talk to someone who's proven to you to know what they're doing. Talk to someone whose incentives you know and understand, like a professional investment advisor, as well as do more research before taking any decisions. And you do research not in a company's presentation. You do research by visiting setterplus.ca. That's where you're going to find the company's official filings. If you don't do that, you are highly likely to lose your money. That's the norm. That should be the expectation in the sector. There are disclaimers on your screen right now. Again, if you don't enjoy losing money, please read them and be careful out there. Take care of yourself and take care of your own money. Take your own responsibility. With all that said, though, I'll kick off the CEO BBQ portion of this Real Money Talks episode by traveling to Quebec. But I'll save you the 10-minute company overview this time because I'm revisiting Matt Manson, who's the CEO of Radisson Mining, on which we did a deep dive a few months ago to go over the basics. And there's also going to be a company playlist on the channel where you can find that first video and any other videos I will do with Matt in the future. But in a nutshell, Radisson is a gold exploration and development company that controls 100% of the O'Brien Gold Project in a camp that's been producing gold for over 100 years now. There have been over 25 million ounces coming out of that region historically, and there seems to be a lot more gold left in the ground. The O'Brien Project hosts a historically producing mine as well, which was thought to be the highest grade gold producer when it was in production at the time. And there is let's call it about 1 million ounces, about a 1 million ounce resource on the project, about 50-50 split between inferred and indicated. But last time we spoke, Matt told me that he wants to see up to 3 million ounces in this resource, which is why there currently is an ongoing 35,000 meter drill program, as well as a recently signed non-binding memorandum of understanding with IAMGOLD, another gold producer in the region, allowing Radisson once and if in production to process their ore at the Doyon Gold Mill potentially. Again, Doyon Gold Mill is about 20 kilometers away from O'Brien, and so that's going to result essentially in creating kind of a hub and spoke arrangement, if you will, which has the potential to result in a lower cost mining operation. And of course, again, potentially, so these are forward-looking statements, if it comes to the point of actually building a mine here, lower capex as well. The company is listed as RDS on the TSX Ventures Exchange in Canada, where an average of about 350,000 shares trades each day, showing a 52-week high of 33 cents and a 52-week low of about 15 cents. With a market cap of $82 million and 320 million shares outstanding, although I will make a note here that that number will have grown by now as the company is raising $7 million, and the first tranche of that was just closed. But at the time of recording, so today there's 320 million shares outstanding, 82 million market cap. That means this is a 25-cent stock. The same would not have been true last time we spoke, Matt, which was a few months ago when you were hovering around, well, the stock was hovering around the 52-week low, actually, 15 cents. But that was also right around the time that you had joined the company as a CEO. So things seem to have turned around, hopefully for the good. But talk to me about that. What have you done since you joined? Why has RDS gone up as much? And then right after that, we'll dive into why it's given some of those gains back already. But starting on a positive note, yeah, why did it go up in the first place?
Well, I think a number of reasons. And thanks for having me again, by the way, Antonio.
Pleasure.
Appreciate it. Yeah, I mean, I joined as a CEO beginning of July, and I wasn't the only change in the company. There was quite a lot of changes at the board level as well. And so as of now, we have Pierre Baudouin as the chairperson, and many people will know him as the builder of Canada's biggest gold mine, Detour, and then more recently the chief operating officer and board member of Silvercrest, that's currently subject to a takeover bid. So he's had a lot of success. And Peter MacPhail joined the board as well. When I came on, he was the chief operating officer at Alamos, built the Young-Davidson mine, did the first expansion of the Island Gold project after Alamos bought Richemont. So he was my chairperson at Marathon Gold. So we have a lot of heavy hitting mine development people on the board at this stage. So I think that opened people's eyes. Over the summer, we were able to get out and sort of meet with shareholders and start telling a story. And so by the end of the summer, we felt we had a really good share register, a really good group of shareholders that were all sort of, pulling in the same direction. And then we began bringing out some interesting news. We released this this details about this MOU with IAMGOLD that you mentioned, that is about doing a technical assessment around our ore going to the Doyen mill, and that was the first time in the history of this company that we said publicly that there was a conversation going on about the next step for this project. So I think that really opened people's eyes, and then we've been through this process. We've been putting out the sort of characteristic good drill results so the O'Brien project can deliver, lots of high grade. And specifically at the end of September there, we released some deep drilling that was very interesting indeed. So I think all of that has, and of course, the gold price hasn't helped, right? And, and the renewed interest perhaps by the market in companies like Radisson, maybe an entry point valuation for a quality asset in a good location. And I think maybe some of that capital is beginning to look at names like ours.
You're also drilling, you're putting out assay results, and that's something we're definitely going to talk about extensively, hopefully in a couple of minutes. But when can you expect to have something more definitive and provide kind of commercial terms to the public of this arrangement with IAMGOLD?
Yeah, so it's a step-by-step conversation we're having with them, and what we're doing right now is purely a technical assessment. There are no commercial terms. Nothing's binding. Nothing is exclusive. There are no commercial terms being contemplated at this stage. But all we're doing is really looking at the Doyen mill was sitting there, and it's it's been there for a while, that facility. It processed originally ore from the Dwyer mine, the original mine that was there with Cambior. And then it's had a succession of ore bodies that have gone through that mill, most recently the Westwood deposit, which is the current operating mine there with IAMGOLD. And so Westwood's delivering about 1,000 tons a day of high-grade ore to the Dwyer mill, but the Dwyer has a 3,000 ton a day capacity. And it's currently being fed by two satellite deposits, YL and Duke, that run out sort of next year. So IAMGOLD have said publicly they're interested in finding ore feed for that mill. We're interested in finding a mill. We have having in my career built or been involved in the building of three standalone big capital projects with all the bells and whistles of a standalone mine, infrastructure, power, pits, underground mines, tailings facilities. This is a different beast. O'Brien is a nice little neat, simple, low impact, low profile underground mine where we don't want to build the mill and we don't want to build the tailings facilities. We've got 5 mills around us that are candidates to take our ore. And there's lots of precedent in the region for just that. And the immediate precedent we talk about in reference is the Lapa mine, which was developed operated over about 8-9 years. It opened, I think, 2006. I was at the mine opening for that. And it produced about 100,000 ounces a year for about 8 years. And the ore was trucked past our project to the LaRonde mill and processed there, right? So that hub and spoke arrangement that you referenced again in your introduction is actually a traditional way of doing things in the Abitibi, and these mills are kept going, by doing that, right? So we're just aspiring to be the next chapter of that, and a little bit more complicated than the Lapa situation, because in that case, Amico Eagle owned the deposit, owned the mill. In our situation, we've got to find the mill. So that MOU with IAMGOLD is really the technical work, which is non-trivial, right? It's the metallurgy of our deposit. It's the flow sheet assessment of their mill. It is working out the design criteria by which our metallurgy goes through that mill. And then it's tailings, its capacity, and the geochemical characterization of our ore and how that would be treated in a tailings deposition strategy at YN. So all of that is non-trivial and is the focus of the work right now. That's my son going out with the dogs.
It's essentially you can call him in for an interview. There's a couple of questions I'd like to ask your dogs, but it's essentially what you're testing now is the compatibility between your ore and their mill. That's kind of how I understand it. Well, let's then assume that this works out and it goes through. You finalize a deal and all the rest. Does a deal with IAMGOLD change any of the timelines that you had in mind when we last spoke? And specifically, what timelines are you working with right now?
Well, I think that the first stage is to work out if there's any red flags, technically in what we're proposing here, and if it's not, I think then we sit down with IAMGOLD and we work out what happens next, right? I think any project, if you can secure a mill and a tailing strategy for your ore, it does speed things up greatly because in the environmental and social assessments of any mining project, the scale of your impact on that site, and the volumes of things that you're dealing with are the key focus of a regulator and a community audience. So if you're not building a mill and processing material on site, if you're not building major earthworks with a tailings facility, if all you're doing is you're not doing open pits, all you're doing is an underground mine, we wouldn't even be doing camp because we're close to town. We wouldn't be doing major equipment maintenance facilities because, again, we've got service providers close to town. So very low profile surface impact. And you're really just building underground mine, putting in a water treatment facility for mine water, waste rock deposition, waste rock piles coming out of the underground mine development, and then maybe some surface facilities for mine drying and offices. That's it. No new infrastructure, new power line. So if that's all you're doing, that is a very simple proposition that you're presenting to a regulator for permitting. So it does speed things up, a lot, right? That said, all we have at O'Brien right now is a resource. We don't have any economic studies. We don't have any engineering work. There has been internal work that's been going on in the background, but without the mill, without clarity on mill direction, we haven't been able to do that. So I think the specific thing, and we said this in our press release back in September when we announced the MOU with IAMGOLD, upon the success of that technical work, we would then do a preliminary economic assessment that would show the value of the project. And we're in the middle of a drill program. We're not going to down tools in that drill program and do any new resource work. The existing resource is based on 270,000 ounces, 270,000 meters of drilling. So we're going to use that. But we would conceive of 1,000 ton a day operation, underground mine, good grades, 80 to 100,000 ounces a year. Produced, probably enough meat on the bones at this stage to do 8 years plus. That's the characteristic, back of the envelope sense of what this project would be. And again, low capital profile because there's a whole bunch of things that we wouldn't be building.
Are you
So
going to need?
yeah.
Yeah, go ahead.
Yes. So technical work with IMU, PEA, getting a sense of what our project is at that stage. Conversation perhaps going further than with IAMGOLD as to what exactly a commercial arrangement might look like.
Somewhere in between that process, are you going to need any special permits or MOUs with the First Nations or any other type of external approval before you could actually go to that PEA? And then eventually before you can actually start trucking the ore essentially 20 kilometers?
Nothing from a regulatory point of view. For a PEA at this stage, we're fully permitted and fully financed for everything we want to do. In terms of First Nations, there is a new framework within Quebec under new legislation that does, and I think this is timely, frankly, does involve mine developers and miners in the Abitibi much more in community and specifically in First Nations consultation. So, we've been sitting here just outside the town of Cadillac. We've got good relationships in Cadillac, good relationships around Noranda, but I think now it's going to be time as we start, making noise about development. The obligation is on us to sort of step up our amount of communication engagement with the communities around us. And that includes First Nations. So I think you should expect to see more of that from us, and any community stakeholders watching this video should expect to sort of see more of us in that basis as well. But in terms of regulatory approvals to go to the next stage, no, not at this stage, right? In terms of trucking ore on highways, yeah, that's going to be, I'm sure, a focal point of any future project assessment under the arrangement that we're contemplating here. But I'll point out that it's 21 kilometers. We're not talking about huge volumes of material here. 1,000 tons a day is not a huge amount of material. And between our project and the Dwyer Mill, it's a straight run of public highway with no residences, right? There's a trail that goes out the back of our property onto the highway, straight along the highway, straight into Dwyer. So it's a very simple proposition. But obviously, anytime you're contemplating that'll be a focus of communities and regulators. But we think it's very, very viable.
Tell me a little bit more about this new framework in Quebec. What exactly does that involve in terms of engaging with the First Nations? What's changed?
Well, I think in a previous life, I developed the Renard mine in the James Bay area of northern Quebec, and that was in the AOHE Cree territory, subject to the James Bay Northern Quebec Agreement. And so there you had a very specific rule book, because you had a regulatory and sort of nation-to-nation agreement structure that you followed, and we were in Category 3 land under the James Bay Northern Quebec Agreement, and so you're negotiating with Cree institutions and Cree entities that are sophisticated and knowledgeable about your business, and so it was a very, very settled and formulated process. I think in other parts of Quebec and true other parts of Canada, it's been historically a little bit more loose. And in the Abitibi in particular, you've got a long history of mining, really without any type of engagement with First Nations. So I think the new legislation that's come down in Quebec really now mandates much more uh, uh, um, company engagement, specifically with First Nations, in areas that perhaps historically have not seen it, like around Val-d'Or and Randa, right? So I think I'm very familiar with that my entire career. Whether it was the first mine I was involved in, which was the Diving mine, which had 5 impact and benefit agreements around in the Northwest Territories, and working in northern Quebec in the AOHE with the Crees. Newfoundland was again a different framework and a different context when I was building the Valentine project with Marathon. So I've seen lots of lots of different models of engagement. So we're sort of happy to go down that path. And I think that is obviously that's going to be one of the new flavors that generally within the Abitibi and with mining companies.
Hmm. That is a good overview. That's something that I always think about, and there's always movements around this, and it's important to be transparent over that and kind of understand how that process goes. Let's talk about the current drilling though that you have ongoing, Matt. 35,000 meters. Is that still the plan? Do you want to grow it? Do you want to cut it short? How's that program going? When do we see news release from that? Talk to me about everything.
Yeah, so 35,000 is still the plan. We're going to have that finished by the end of the year. We're up to 3 rigs now. Fully funded from existing resources. The financing we've just done, the 7 million, is about next year's work. So we'll just go seamlessly from this year into next year, frankly. But we'll have the 35,000 done by the end of the year. Yeah, and we're now putting out drill results every few weeks, quite regularly. So we should expect the next. I think the last drill results were put out at the end of September, and that was 3 holes we put out, and which is unusual. We don't usually put out so few holes. Usually it's 8, 9, 10 at a time. We put out 3 because we thought they were very meaningful and material, and we'll talk about that. These are these deep holes. There'll be another batch of holes relatively shortly, we believe. And then, pretty constant flow of drilling news going forward. I mean, I would have said until that financing just done, this 35,000 meters will give you drill results through until the end of the first quarter of 25. But we're going to go right the way through, right? There's meaningful work to be done with the drilling. And I think our target for this project as explorationists, as geologists, looking at the style of mineralization, the grades and the thicknesses we're getting, and the amount of room we've got, and understanding it's mesothermal gold, we think upwards of 3 million ounces is a reasonable target here, and that's not me speaking as the new guy. That's been the target of the company for a while, and that's perfect. I fully endorse that. It's perfectly reasonable, and I think that's where we're going to get to. It's going to take a lot of drilling to get to that, right? We've got 1 million ounces right now after 270,000 meters of drilling, and that's because this is narrow and high grade and going deeper. So to do this right, you do have to have a lot of drilling. You have to have dense intersections. You've got to understand the continuity of your ore body, right? So it'll take a lot of drilling, but it's going to get there. And I think why I think we're excited about this project is yes, we're going to get up to that number eventually. But at 1 million right now, I talked about Lapa being the precedent project for getting to a development stage and speeding another mill. O'Brien has passed that line at this stage, right? It will do 80 to 100,000 ounces a year for 8 years plus. So you're already at a stage where you can start talking turkey about a milling scenario, right? Whilst all the exploration is going on and whilst you're chasing that bigger target.
Loads to talk about there, but specifically what you just mentioned, high grade, narrow, deep. That's where I want to go with this and kind of take it step by step, because I'm thinking about how are you going to be dealing with great variability and the potential for or the risk for nugget effects. Like in your hole 324 from the 24th of September, again, that you just mentioned, there was a 100 grams per ton intercept that was really only about a half a meter. No, only about 1 meter. So 1 meter, not half a meter, but it is apparent with 1 meter. So, and you mentioned 40 to 80% of it is going to be true with. But then also as discussed last time, the veins at the O'Brien project, they kind of range from a few centimeters to a few meters at times. So do things like grade variability and width variability worry you on the team or the team, and how are you going to be dealing with that?
I wouldn't say it's a worry. I think it's the nature of this ore body that to be confident on the continuity of mineralization, the continuity of grade, you've got to have the right amount of drilling, and you've got to have the right approach to the estimation of those numbers in your resource. I mean, so one of the first things I did before I joined this company was look to see who did the technical report for the resource, and it was Luke Evans at SLR, who's got a very good reputation. And Dave Ross, who was the vice president of exploration at Marathon Gold and then subsequently Calibre upon the acquisition last year, has just joined Radisson as VP exploration here. He was the guy who took the resource that we had at Marathon and really made it fit for purpose for financing and mine development. And he's done his due diligence as well. So how the drilling, the resource, the grade, capping, the estimation methodology, how that's all been done is the domaining of the resource with a vein model. All of that work has been done well and has been done, right? Which is, there are lots of projects where that doesn't get done, to be honest, right? So it's been done and it's been done well. Then, getting back to things like 100 grams over 1 meter, yeah, that's the nature of our ore body. I think, we had a batch of drill results over the summer where we had a 6 meter mineralized envelope, right? Which was a 40 to 80% true width. So that was probably 3 to 4 meters of actual true width, right? And it averaged about 25 grams over the 6 meters, but there was a 137 gram interval in the middle, 1 meter, lots of VG, and the rest of the interval was probably 3, 4, 5 grams, right? So we had a debate. How do you represent that? Do you represent that as a 6 meter intersect at 25 grams? And I don't think you do, because you're mining the 137 gram 1 meter in the middle, and you're taking dilution as you do that, and your dilution has grade. So I think we called that. I think we led with the 137, and I'm sorry if I'm getting the numbers wrong. It was about 130 something, 137 grams over 1 meter in a mineralized interval that was 6 meters at averaging 25 grams. That's how we described that. We led with the narrow high grade thing to give clarity that that's what was driving the grade and intercept. Then at the end of September, hole 324, we had the opposite. We had a 6 meter interval that averaged 27 grams. And there was a hot, into 1 meter interval in there, but it was VG the whole way. And we had in that interval, we had a 20 grammer. It was, I think, nothing below 9 grams or something in that interval, right? So, and then there was a hot one in the middle. So that was genuinely 27 grams over 6 meters, because we take out the whole thing, right? So I think how we actually present our data in the calculation of intercepts is really driven by our, how we conceive of what the ore body is. We're very clear. This is a narrow, high-grade deposit where minimum mining widths, mining methodology, mechanization, dilution, all of those things are very important, right? And also, because you're mining a narrow, high-grade thing, definition drilling, assessing your continuity, how you're capping your nuggety gold, is really important. And I'll back off a little bit here on the nuggety gold thing, because, and we're getting in the weeds of how a resource is estimated here, but, our deposit is characterized by high grade, visible gold, intercepts, right? So you could call those nuggets, or you could say, well, that is actually what the ore deposit is. Our marketing material has these spectacular VG samples, and those are museum quality samples that came from the O'Brien mine, which are currently in the Royal Ontario Museum in Ontario, right? So this is the project that delivers the museum quality VG samples. And so you could say that's just a nugget, and it is nuggety, and you've got to understand that geostatistically, but it's also it's what our deposit is. It's narrow, very high grade. We're getting 100 grams over a meter is common, right? So um, we're putting our miner hats on here. We're assessing how you measure that, how you mine that. But that is what the ore body is.
But I suppose come time for the resource update or a PA or whatever else it might be, again, it's going to take more drilling, tighter spacing, and all that. But you're also going to be applying a cap to those grades, I suppose. Any idea
Oh yeah.
as to where it's going to be capped?
Oh, I think it is capped, and I think the capping of the high grade in the resource that SLR did in 23, I think was 40 grams. I think that was the top cap. And then, when you're doing a resource, you not only, cap, just, you know, guillotine the top grades out of your resource. You can also do threshold restriction as well to limit the impact of those grades after that
Yeah.
capping. Um, so I think you can squeeze the impact of your high grades a number of different ways, and that's I think both of those were here in this resource estimation. Um, like I've come into situations and looked at resources where there was no capping, and there was no threshold restriction, and there was no domaining to restrict the algorithm doing what it wanted to do, and that's not uncommon, and especially at an early stage
Hmm.
resource for a junior company that's really wanting to give sort of quantity over quality kind of attributes to the deposit, and that's in a very, very, I think not capping your resource is probably a sin in any kind of situation, but there is merit at the very beginning of a project to be communicating the size potential, right? But you get to a certain stage where you say, well, no, it really has to be, it's quality over quantity, and I was happy to see a lot of quality attributes in the resource that had been done for Radisson.
And it's the market, right? I mean, the market just likes high grade. 100 grams over a meter might sound more interesting than 1 gram over 100 meters, even though it's both 100-gram meter holes. But what about?
Well, yeah,
Go
I
ahead.
mean, look, you just have to, yeah, grade is king for a reason, right? There's lots of 1 gram deposits over 100 meter that won't get mined because you need to be able to do that on a big scale, right? Even at $2,700 gold, right? So 100 grams over 1 meter is an incredibly high margin deposit, right? And then you how big can you mine? It was the right size of mine. For us, that's 1,000 tons a day, right? That operation, right? A third of a million tons a year, right? But those grades, that gives you a very good result. So I would have 100 grams over 1 meter over the 1 gram over 100 meters any day of the week.
Hmm. Well, grade, like a customer, is king, but it's not always right. And what I mean by that is that you also need the metallurgy to be working out with you
Right.
there. What about arsenic and arsenopyrite in your case? I assume as the grade grows, you might be encountering more of that. Is that becoming a concern? Is there a plan of action to deal with it? How do you look at it?
Yeah. So we have arsenopyrite in the mineralogical assemblage. It's gold with pyrite and arsenopyrite. Those are the principal sulfide minerals. Um, that's not uncommon. That's actually very common for the Cadillac Larder Lake Break types of deposits. Again, Lapa was exactly that, same, right? So what that means is that when you process that ore, you end up with an arsenic signature. And if you do flotation, the arsenic will be in the float con, and you can sell that to a refinery that takes that, right? And there are projects in Canada right now that are contemplating that, and there are refineries in the world that will take that product. Or if you take it to doré yourself and take it through a leach, the arsenic will report to your tailings, and then you have a tailings deposition strategy to deal with that there. So all of this is doable, manageable. It's not a red flag, and very much that is the purpose of some of this technical assessment we're doing with iron gold right now, is to work out exactly what the right sort of mechanism is going to be. We want to understand, where that reports and the quantities of things, but it's not a red flag for us. I think uh, there is a component of our gold that is contained within the arsenopyrite, pyrite, and most of our gold is free gold, and that's what all the visible gold is. And so when we do our metallurgy, we get a very high recovery after gravity. It's over 50%, and that's the free gold coming out. The last piece of it is within the arsenopyrite. That's called refractory, and I want to point out that's the last piece of a recovery here. All the VG is telling you a different story. The last piece is there. And that's the difference, we think, between about 85% recovery and about 92% recovery in the final product. Our resource assumes 85% recovery. So that issue is already built into our numbers. And anything we do better than that is upside, right? So there's a MET program going on right now to work out exactly what is the best way for us to go. Are we selling a concentrate, or are we going to doré? And I'm thinking about that in the context of the Dwyer mill. And we are expecting to get a result that's in the low 90s recovery with a flow sheet that we're currently contemplating, right? But so none of this we see. This is just work that I think we have to just do to know what the numbers are and to see how it's going to work out. But it's a very the metallurgy of our project is not unusual in any way, and it's quite actually characteristic for that region.
Does the metallurgy change with depth? And this is a point where we can actually go and start talking about what you've been hitting, because you've been hitting a lot of this kind of at depth. We've the vertical depth extent of the hole was 1,100 meters, whereas a lot of the resource that I talked about in the overview, the almost 1 million indicated and inferred resource, 75% of that is at depths above 600 meters. So yeah, talk to me about how the deposit seems to be behaving beyond that, and what you think the lateral continuity of the deposit will be.
Yeah, no indication that metallurgy changes with depth per se. We are doing the work to establish metallurgical block models, so that we've got a gold block model, obviously, but having a sulfide block model as well, so that we understand the scheduling of the ore from a metallurgical point of view, as well as a production point of view. And that allows us to correlate gold with different elements, right? Gold and sulfide, for example, is a relationship, the grade and sulfide. So I think generally we do see a relationship between grade and sulfide. Obviously, the more mineralization you've got, the more sulfides you've got, and the more gold you've got. That's kind of pretty obvious. But we don't see any specific trends with depth or even geology at this stage, right? So again, mesothermal gold. So we're in mid-crustal depths here. Currently eroded to those mid-crustal depths. So whether we're talking about a surface sample at 0 depth, or a sample at 2 kilometers depth, which we think is the exploration horizon, we're not really talking about a great crustal depth variation there in the context of a mesothermal gold model. So in an epithermal deposit, you might get that, a lot of variation over that type of interval, but not so much here, I think. Or at least, it's not visible to us in the data we have. So, no, nothing for us to give us any indication anything would be different, with depth through that exploration horizon.
How deep do you think this thing goes?
Well, we have a graphic in our PowerPoint presentation that shows the depths of all the deposits in long section along that belt. And you got Lapa, for example, which goes from like half a kilometer down to 1.5 to 2. You've got LaRonde, which is a completely different beast. That's a massive sulfide, which is going down to 3.5 kilometers. For a mesothermal, vein-hosted gold deposit, gold sulfide veins with quartz veins, I think, again, our horizon is 2 kilometers. There's nothing to suggest that there's no geological reason why it would stop in any way before then. And I think, in terms of our deep drilling, at the end of September, we put out 3 deep drill holes. And again, just to back up here a little bit, that the nature of our deposit is that we've got this Cadillac Larder Lake break. We've got this thin package of rocks called the P-shade group up against it. A variety of different styles of rocks in there, but it's a package. And we've got a big slug of Pontiac sediments kind of, out here. We drill through the Pontiac sediments, we come through the P-shade group, and then we hit the big structure, the break. And it's within the P-shade group that we see all the veins. The veins are east-west, sub-parallel to this package of P-shade group rocks. And there's really good continuity of mineralization within the veins. We always hit the veins. We always hit these highly sheared veins and altered zones within the P-shade group everywhere, right? And the old mine showed the continuity of the veins in the mapping of the old mine very clearly. And we've got a lot of well-mapped levels from the old mine that clearly show the continuity of the veins. What we're chasing are these pant legs of grade, because the veins will bunch up, they'll coalesce, they'll intersect, and you get these areas that are wider and higher grade and lots of VG. And those seem to have, those areas of confluence of the veins seem to have a lot of vertical continuity, and that's where the grade is. So when you look at how our resource, the new resource to the east of the mine is laid out, you see it's begun to form these pant legs that are going down. And that's just the drilling empirically resolving where thickness and grade is and giving you good resource. And it's where you got this coalescence going on of these veins. The veins themselves you always hit the veins, right? But we're looking for those thicker areas of grade. And within those thicker areas of grade, you'll get 1 meter of VG and 100 grams, right? But it's kind of a package. So we were drilling, the company has defined these pant legs with trend numbers, trend 0, trend 1, trend 2, trend 3, trend 4, trend 5. And the best stuff seems to be at the moment trend 0, 1, and 2, which are the ones closest to the old mine. And you see the pant legs coming down. The deep drill holes we drilled, and I'm going to get to talking about deep stuff here in a second. So, I'm going to bring this back to where we started. We put 3 deep holes below trend 1, the pant leg of trend 1. A western hole, a central hole, and an eastern hole. And they were designed to find that pant leg coming down. And 2 of the 3 hit. Hole 324 is this one that gave 6 meters of good grade the whole way through. It gave us an ounce over 6 meters, right? And then it actually had a second zone afterwards, which was good grade over. I think it was 10 meters of 7, and then there was jump over to the hole to the east. That also gave a nice intersect as well of high grade over thick intervals. The one in the west gave us bits and pieces, but didn't hit the pant leg. So 2 out of 3 hit that pant leg, and we can see where the pant leg is going. And those 2 holes hit 170 meters below the previous deepest hole, which was an ounce over 3 meters. So we've got an ounce over 3 meters here. We've got an ounce over 6 meters down here. And we've got 170 meters in the gap, right? The next batch of drill holes we put out will include wedges, which we're attempting to fill that gap. But what that's saying is that this thing is we've just come down 170 meters, and it's the same stuff, right? And now as we go deeper and we come in, these are long holes, and it's getting more expensive to drill when we're drilling from surface. But we can go pretty deep from surface, right, with our drill contractors and with the drilling costs we have at Abitibi, quite reasonably. So there's nothing to tell us that system is not continuing at depth with good grade and good mineable widths. And I think we're going to have the courage now. So I don't want to be disparaging about the lack of courage before, but we're gonna have the courage to sort of go deep here with our drilling, right? And to go below the old mine, which has never been done, right? And to go deeper into areas where you're not necessarily doing a small step out because you've got a nice resource here. So I'm going to do a small step out and try and just incrementally increase the resource. We're gonna go deeper and see what's down there, right? And those 3 holes that we're chasing the trend 1 pant leg have given us a lot of confidence that that's a worthwhile thing to do.
What's the size of the step outs that you want to do for the testing of the depth?
Well, that was 170 meters. 100 to 200 meter type step outs, yeah, or more, right? Okay. Or more. I think we if we drill to 1,500 meters depth in this project and we hit something, I think that will really open people's eyes, right? And these are high risk holes, right? When you're doing that, the chance of hitting nothing is pretty high, to be honest. So, but we're having the courage to do that, and I think if we have success doing that, I think people will really, wake up and realize what O'Brien is, right? It's not that project that's been there for years that you've heard about that, yes, can deliver a lot of these types of grade results, but doesn't seem to be sort of going anywhere. I think if we can hit at these deep levels, obviously we're not mining that tomorrow. That's a future mining scenario we're talking about, but it really will open people's eyes to the scale of this thing potentially.
Well, especially if you do 200-meter step outs, right? Because it's gold, high grade, narrow veins, and if you have 200-meter step outs, would open people's eyes, I believe. Have you had any troubles with recovering core from those depths, though? I mean, is there a core loss here, or like, are you recovering everything properly?
Everything is being recovered very properly. The RQD on this rock is very good, really good. That's a question that we do often get, especially from people who have experienced mining in the area, because there are some projects around there that have had bad ground problems in the past. So we're actually blessed, I think, in this regard. So very good core recovery, and a very good geotechnical, data coming back from the drilling. So yeah, no, at those depths, we no problems at all. And we very rarely have a failed hole, right? Very rarely. And the drilling goes to completion once we've gone through the P sheet group, and then we go through the Cadillac Lower Lake break, and then we're into what's called the Cadillac sediments, and that's when we end the holes. So we hardly ever get a hole that doesn't actually complete the full journey.
Well, so of that 35,000 meters here, Matt, that you have a plan of drilling, what percentage is focused on testing the lateral extension versus growing ounces at closer to surface?
So I think the project was conceived, the drill campaign was conceived at the end of last year at about 20,000 meters, and then it was expanded in May to 35,000 meters. And I joined in the beginning of July, and the definition of the program when it was expanded was to be about 60% shallower drilling focused on gaps in the resource and growing resource within those areas, and about 40% the deeper step out stuff. We're reorienting that a little bit. I mean, in the last few weeks and months of this drill campaign to the end of the year, we will be going deeper. And there is one hole that we're doing right now which is quite deep, and it's below the old mine again for the first time, never been done before. So high risk, don't know what we're going to get. We may get nothing, we might get something, and we're going to use that hole as a base to do wedges and to again have some courage. But that's the type of drilling that we're going to I think orient ourselves towards. I mean, if I was to be a good analog for this, Antonio, and this is shamelessly promotional, so take this with forward-looking statements apply to what I'm about to say here. But we have an analog in Quebec for a project that was focused on the top of the mine for years. And I'm talking about Island Gold and Richemont, right? So when Richemont was operating Island Gold, it produced about 1 million ounces, during those years. And there was a debate within Richemont as whether or not the focus of the company should be on getting the mining right. And it was a bumpy road for that project for many years. Get the mining right or drill deep. And eventually the drilling deep argument won, and they began to hit really nice stuff at depth. And they were doing big step outs. And Richemont went from 100 million market cap to like 750 million market cap, and was bought by Alamos. And Alamos was criticized at the time for seeming to have overpaid. And I think Richemont's resource at that stage was about 1.6, 1.7 million ounces. There's a really good verify sequence on the Alamos website. I'll refer people to see the before and after. But Alamos hadn't overpaid. They did a really good job identifying the geological characteristics of that project, the upside of that project, and they bought it when it was about 1.6, 1.7 million ounces. It's now, what is it now? Over 5 to 6. Terrific ore body. A cornerstone in Alamos's story. Really well done. Peter MacPhail was the chief operating officer of Alamos, now on our board, my chairman at Marathon. He was there when Richemont was purchased. He was there for the first expansion of that project. And so I'm not comparing our project to Island Gold. They're different deposits, different settings, different beasts. But what is a correct comparison is that both projects had a focus on the top, for a long time. And then when courage was applied to just, damn the torpedoes and go deeper and see where this thing goes, it opened people's eyes to the true potential of the asset, right? So I think that is a lesson that we've taken on board. And I hope we have a not dissimilar outcome, when we go deeper. But geologically, again, mesothermal gold deposit, narrow vein, high grades, Cadillac Large Lake Break, Piche group. There's nothing to say that we don't have the same characteristics of mineralization, at those deeper depths. And our drilling to date with that 170-meter step out is showing us that.
Are you also going to have any meterage dedicated to looking for new shoots outside of the known zone or outside of the depth extension that you're describing here?
Yeah, I think that's a good question, and I think I think that's a topic of conversation amongst the exploration people in Radisson right now. We do have a little bit of resource on the western side of the old mine at the Thompson Cadillac. There's 3 old shafts and 3 old mines. O'Brien's the main one, but there's Kawagama on the east and then there's Thompson Cadillac in the west within the property. So there's gold the whole way along. When you're a smaller company, budget constrained, you do tend to go where you're going to have results, right? So in the past, that's been a motivation to sort of stay shallow. And right now, as we're going deeper, to be honest, it's a motivation as well, but it's a motivation to go deeper on the areas that we know are going down, right? Which is trend 0, trend 1, trend 2. So I think it's a very on point question, and I hope that we will be doing that as well. But let's no promises on that one.
You have added a third rig, as you just mentioned. So what are you drilling now? 50, 200 meters of shift?
Yes. Yeah, I think probably up to 200 meters of shift. Obviously, when you're down with these deeper holes, it's less. And when you're doing wedges, it's less. We are still drilling some holes that are only going to about 300 meters depth. So there is a mix going on of deeper and shallower, as defines that, the original concept, which was 60-40 split. So there is some deeper, shallower drilling going on. But at this stage, we're a small team, small exploration team. So it's all hands to the pumps, I think, with the amount of core that's being delivered right now.
Well, why I'm asking that really, Matt, is because I'm wondering whether having this third drill rig is going to have you complete the drilling sooner or have assays out quicker. So what do you think?
That's just to complete the 35,000 meters this year, and to be honest, Antonio, some of this is we're spending flow through dollars that have to be spent at the end of this year because they were raised in 2023, and so you've got to incur the expenditures before the end of this fiscal year, so this calendar year. So the 3 drill rigs have been planned for a while, but that is in the context of completing that 35,000 meter program before the end of the year. We don't have the luxury of going over into January with those 2023 flow through dollars. The flow through we've just raised, will be spent before the end of next year. So we'll probably go back down to 2 rigs, at the end of this year for the 25 program. Again, still to be sort of laid out properly. But that's an element, but also the 3 rigs are actually allowing us to be more aggressive with the deeper drilling because we can have a rig focused on those shallower areas where we've got holes in the resource that we want to test, and then we can have a couple of rigs doing these longer deeper holes, and then when you map that through to the delivery of results, you get a pretty smooth sequence of drill results coming out from that type of mix.
So how many meters do you have left to complete then before the end of the year?
Oh, good question. I think it's probably about, yeah, I mean, I think we're probably about two-thirds of the way through the program. So there might be, 8 to 10,000 left to do before the end of the year, which I think we'll achieve quite handily with those 3 rigs.
Yeah, that should be doable. I mean, if you have 10,000 left, it's not a good idea for me to do math off the top of my head, but you're
No,
probably like
it's
you have
probably
60,
not.
you have probably what 60 days left before the end of the year. I mean, I
Yeah.
don't know what you do for Christmas holidays and whatnot, but that's probably
Mm.
like 150 to 170 meters of drilling, I would
Yeah.
guess, per day that you have to complete in order to be done on time. So why I ask you that is because I'm just trying to figure out how realistic it is for you to actually be done by the end of the year, but it does
Oh, yeah.
seem doable.
Yeah, look, I think, yeah, if you do the arithmetic, I think it all works out.
Hmm. Yeah. Yeah, no, that's fine. You've also been raising money on the back of the excitement in the share price. Understandably so. Initially, you set out for $3 million, though, but then you upsized it once to 6 million on the same day, and then you upsized it again to 7 million just a few days later.
Yep.
You've closed the first tranche, so I assume you're not going to be upsizing it anymore. But how come? I mean, if you thought you could get the job done with 3 million, why take the seven?
Well, we kind of expected it to go that way. I mean, we were doing it non-brokered, right? So and we knew there was about $3 million of immediate demand amongst friends and relations,
Okay.
basically people that had put their hand up and said, when you're financing, I'd like to do something. So we knew there was, it wasn't a bought deal with a broker. It was, we knew that demand was there. Uh, Michael Gentili, of course, who is on our board and as a savings shareholder, has a significant network of investors who he's close to. Um, so we knew there was a $3 million book. And so we said we'll launch a financing at 3 million. But as soon as we were public that we were financing, we knew that there would be more interest, and there was immediately. So we upsized to 6, and then again, it got upsized again, right? So I think we were prepared to do something smaller, but yeah, it kind of it went that way, and to be honest, we kind of expected it to go that way. We've had some very good feedback as we marketed through the summer and into the fall,
Hmm.
so we knew there was demand there. And when you do a non-brokered financing, um, uh, you get to see the book, right? And when you're doing a bought deal with a dealer, which, to be honest, which I've usually done in my career, the dealer is taking on balance sheet risk, and so they run the book, and you can influence who's in that book, on the basis of your relationship with the dealer. But at the end of the day, it's their liability, right? And your shares will end up with some of the faster money investors out there. So when you're doing it yourself, you've got a personal relationship with every single buyer in that book, and you know who they are and what their motivations are, and are they long or short, and what are they trying to achieve, and that's terrific,
Hmm.
right? So we can tell you that everybody in that book is a high quality investor who is aligned with what we're trying to achieve in the company, and we did a number of different party pack type elements. There was hard dollars there, just in a unit deal. There was a Quebec flow through piece. There was a national flow through piece, and then the second tranche is a charity flow through piece. So we were flexible enough to do that, and the net result is a certain amount of hard dollars, which is walking around money, corporate costs, non-exploration related salaries, etc. And our burn rate's very low at Radisson.
Hmm.
And I'm working from home, as you can see here. And then most of that financing was flow through, which will again finance the work next year.
Hmm. Well, you seem to have a
A
beautiful.
flow through with primarily individual investors who wanted the flow through and want the shares.
Hmm. You seem to have a beautiful home, so I wouldn't mind working out of there either.
Type book.
But talk to
And
me about how far that money is going to get you, though. The $7 million. Is there a clear plan now for how many meters you're going to drill on it? How much is going to be G&A? How are you going to be marketing and all the good stuff?
Yeah, so with the existing funds we have, and of course our current drill program work is fully funded. Um, we'll end the year probably with a healthy cash balance, and of course, and one of the benefits of doing a non-broker financing is that your fees are a lot lower than they would be otherwise. So the cost of doing the financing is significantly less. So we're going to end the year probably with somewhere $8.5 to $9 million in the bank. Um, and for a company like Radisson, with the drilling costs, we've got $175 Canadian all in per meter, um, and the low overhead we've got corporately. That will certainly, I think our corporate burn rate is not more than $1.5 million a year. So, that's $8 to $9 million will be probably a couple of years worth of corporate burn
Hmm.
and a full year of exploration drilling with a healthy program. So that's a good position to be in. We don't want to overfinance, right? We're sensitive to shareholder dilution here. So that was a good size of financing. Well done, quality hands, well priced. Good response when we did it. And that's certainly going to set us up for a healthy year next year.
But you don't think your G&A is necessarily going to go up? Like, what are you budgeting for 2025 G&A?
Well, probably about $1.5 million. Yeah, I mean not a huge amount.
Okay, so give or take 100 grand a month.
Yeah. I mean, we're in budgeting, season right now, but yeah, we don't have a heavy burn rate in this company.
That includes marketing, I suppose. What
Yeah,
are you doing for marketing? I mean, since you came in, you have ramped up marketing. I've seen you at a couple of conferences. I think you're going to a
yeah.
couple of more. What are you going to be doing for marketing? How are you telling the story?
I think we're out, very happy to be doing pieces like this with you. We're trying to reach a broad market of investors that maybe perhaps have heard of Radisson, heard of the O'Brien project previously, but maybe have sort of set it aside and haven't been thinking about it for a while. So when we reach investors, that tends to be the reaction. Well, I've heard about this before. What's new, and then I think we open people's eyes to what this is, and I think very much that was what was so significant about our disclosure around this MOU work with IAM Gold, because
Hmm.
that really sort of woke people up that this
Yeah.
thing was actually, moving forward in some capacity, right? So, um, I think if you look at our share register, who's invested? Um, we've got about 9% management insiders,
Mhm.
which is reasonably high for a company that's been around for a number of years, right? Companies that have been around for a longer time period. You cycle through management, and the founders have left, and the seed capital is not there anymore, and you end up with a smaller proportion. So 9% is pretty high, and I've been buying in the market, and I was subscribing to this recent financing. But then you've got a really important piece, which is about 35% of our shareholding, which is about 35 individual people, high net worth individuals that are in the region of the Abitibi, knowledgeable about the mining industry, maybe maybe uh, own and operate businesses or providing services to the mining industry, and in many cases, significantly wealthy people, right? There's been
Hmm.
significant wealth generated in the Abitibi for many years. So they're very aligned with what we're trying to do. They very much want to see O'Brien kind of, go somewhere. So that's an important block. Institutional shareholding is a smaller piece, 20%, right? That's the opportunity, I think, to grow the shareholder base because it's relatively thinly held there. And that's really because it's been a pretty bleak market for the last 3 or 4 years, with institutional, buy side guys, long only precious metals funds investing in precious metals names. We've had 3 or 4 months of joy here where especially the mid caps, I would say, the larger single asset developers have all had a really good run here. And so the amount of funds under management by these institutional investors has grown just through that. I think new money might be appearing for the first time in a while. Redemptions have stopped. For many years, it was, well, I have to sell something to buy something type market with those guys. So
Hmm.
that and several years of that type of desert for those investors means that companies like Radisson end up with a relatively thin institutional shareholder base in their shareholder base, right? So I think, are we at the stage where this gold price environment and the run that some of these larger companies have had has created capital that's going to go down into some of the smaller cap but quality names like Radisson? Maybe, right? So I think that's a growth area for us for sure, right? To focus on. But I'll tell you this, something that I think is really important is this type of marketing, this type of conversation. And you, Antonio, you do a very detailed, long form type of format here, which is really good. And because the investor you're reaching, those are the investors who are buying and are coming into the market and are picking names and going after quality projects with quality teams for specific reasons. That is important. And the passive investor world, the ETF world, that's getting more and more of the larger money dollar, right? And that they aren't picking companies and they aren't picking names and they aren't picking projects, right? So I think very much your audience and the audience of other people that we speak to, like Peter Grandage's audience and people that we've worked with in that regard, is really important to us, right? And so that we're doing a lot of that, and we'll continue to do that.
Yes, and I think if I may, I'm going to give a shout out to Christina, who makes all of these things happen. She's very good at this, and so she's got you on a good path, I think. So shout out to her. And I think I've been I'm probably forgetting to ask you a few things here, but I'm sure viewers will ever so kindly remind me of that. But what else though? What am I forgetting to ask you that you think we should be talking about here, but I've not brought up yet?
I think you've covered everything, and we've gone over the geology, we've gone over the upside potential, we've talked about the MOU, we've talked about metallurgy, we've talked about mills, we've talked about the market and our financing. So yeah, I think you've got everything as usual.
This was indeed a good overview, Matt. You're right. Thank you for the kind words there too, and thank you, of course, for sitting down with me and for your support of Research Talks. It is much appreciated. I'll let you get to your actual work now, though, and I'll be I'll be staying in Canada, so not too much of a travel, but still a little bit, because I'll be traveling a bit to the southwest from you, as I am headed to BC again, British Columbia, of course, but not to spend quality time camping in the Rockies and not even to mountain bike at Whistler, as much as I might like to do that. He said I'm going to be looking at what seems to be BC's newest gold belt, which is, as a matter of fact, not too far off from Whistler. So this is southeastern BC that I'm going to. And luckily, I won't be going on that journey alone, as I'll be joined by Gareth Thomas, the CEO of Westhaven Gold. Westhaven, as the name suggests, is a gold exploration company listed as WHN on the TSX Ventures Exchange in Canada, where an average of about 170,000 shares trade each day. And I also see a 52-week high of 34 cents and a 52-week low of 11 cents. There are 188 million shares outstanding, and with today's $28 million market cap, that means WHN is trading at about 15 cents per share. Adding options and warrants to the mix leaves us at about 216 million fully diluted shares. Directors and officers here own about 20% of the company. Institutional investors own 24%. 8% is noted down as friends and family of the company, and so that leaves us with about 48% in the hands of retail investors. The last officially filed financial statement on setterplus.ca, which shows me the numbers as of June 30, 2024, had close to $1.7 million in current assets on it, most of which at the time, specifically $1.1 million, was cash, with $420,000 receivables from a BC mineral exploration tax credit. It is worth noting here, though, that again, this is this shows the numbers as of this summer, so at the end of June. But Westhaven recently closed a $6 million financing, which, by the way, included a $1.5 million investment from Rob McEwen. So the current numbers are different than what I'm going through here. Total liabilities at the time, though, sat at about $2 million, about $1.2 million of which was reported as current liabilities. Half of that spent, or $500,000 of that, give or take, was related to the flow-through share premium, and then a little over $500,000 was account payables and accrued liabilities. Whereas on the non-current side of the balance sheet of the liabilities, I see about $800,000, mostly in the form of a deferred income tax liability. In terms of operating expenses, the 6-month period that ended on June 30 this year costed Westhaven, and that is excluding share-based compensation and amortization, as both of them are, of course, a non-cash expense. But so that 6-month period costed them just under $1 million. That's $842,000 to be specific, which is an average of about $140,000 per month. The largest element of that spent was salaries, benefits, and professional fees, which combined accounted for about 60% of the total spent. The second largest element on this income statement is advertising and promotion, which accounted for about 20% of the overall spend. And then you have G&A, travel, insurance, and a few other smaller things making up the remaining 20 or so percent. As for exploration and evaluation costs, you won't find them on the expense sheet here because what Westhaven does get capitalized, so they are on the balance sheet instead. And that means you're going to have to scroll down to note 6 in this case in the financials to see how the sausage gets made, essentially. And more specifically, from the exploration and evaluation angle, the first 6 months of the calendar 2024 costed Westhaven about $2.4 million. And again, that's excluding related share-based payments and amortization and non-cash expenses like that. That $2.4 million divides by 6 to give us an average monthly exploration cost of about $406,000. About 60% of that cost went to drilling. So actually going into the ground, I suppose, with the second biggest chunk here being the 35% spent on geological work and assays combined. So in summary, we've got $140,000 a month going into administrative expenses and $405,000 going into the ground, leaving us with an exploration to administration ratio of just under 3-to-1, meaning roughly 75 to 76% of the money spent over the first 6 months of this calendar year went to exploration and evaluation, and a rough 25% went into administration. As always, though, please understand that this financial statement is nothing more than a snapshot in time. In this case, it is specifically at the end of June of this year, and it simply shows you what the finances look like on that exact date and nothing more. Finances, though, are a fluid thing, and math could be hard, especially if you're me. So I could be making mistakes in my reading of them, and it is imperative that by the time you're watching this, you visit the company's website as well as sitterplus.ca to look at the most up-to-date numbers yourself and make sure you're getting the full picture. For Westhaven, again, that full picture is fully focused on British Columbia, and that is southeastern British Columbia specifically, as I said, with their flagship asset, which is, by the way, the largest one of the in total 4 properties in the company's portfolio, being located at about 2.5-hour drive from Vancouver. And located, actually, all 4 of the assets, which total almost 61,000 hectares, are located on the Spence's Bridge Gold Belt, which is not a name you hear often here in Research Talks, but it is the belt that houses Hudbay's Copper Mountain Mine and Teck's Highland Valley Mine. Both copper mines, by the way. Looking for gold at the Chevaux Nose property, which again is the flagship for Westhaven, is no longer just a theory, though, as they made a discovery here all the way back in 2018 when a drill hole came back carrying 24.5 grams of gold per ton and almost 110 grams of silver in an almost 18-meter intercept, which was then followed up by an even higher grade intercept on that project but on a different target, which I'll say something about in a second. But it was followed up on the same project in 2022, showing over 37 grams of gold and 210 grams of silver over 23 meters. And then it was followed again in 2023 by a highlight of almost 40 grams of gold and 50 grams of silver over 12 meters at a different target, still on the same project, though. Notably, all 3 of those intercepts were drilling again in different zones of the project, but they're extending kind of from the south to the north of the belt, as you can probably see on your screen right now. And that is, by the way, just the northern extension of what looks like an 11-kilometer corridor, essentially, which shows a geophysical anomaly that is largely undrilled as of yet. The south zone, though, the one that is in the north part of the corridor, but the south part of the north part, if that makes sense, the intercepts of which I gave you earlier, that already has a PA on it, outlining a potential underground mining scenario with an almost 10-year LOM and an after-tax NPV 6 of $222 million with a pre-production capex of about $150 million, resulting in an NPV to capex ratio of almost 1.5. Again, though, that's not it. The company believes there's more gold along this whole trend, which is also why a 4,000-meter drill program started in late August this year, and it's aimed at 7 new targets. So that's going to be part of what Gareth and I will be talking about later on. But there's also a reconnaissance exploration program going at one of the other and smaller projects that Westhaven controls 100% of, with that being Prospect Valley. So hopefully we get an update on how that's going as well later on in the conversation. But I'm not going to spend too much time on it right now because, and then lastly, there's Skookumka and Skookumka North. They're the properties closest to Teck's Highland Valley copper mine, and they're both believed to have the potential of hosting gold and silver. So we're talking about epithermal style precious metals deposits here. But that, of course, requires a lot more work, and there are only so many dollars to go around in junior mining and only so much time. So hopefully Gareth and I can talk about how and what they're prioritizing right now, as well as what the plans are for these 4 projects down the road and the business strategy behind potentially leveraging them again later in the future. For some of that to happen, though, I'm going to have to start shutting up already and kick off the actual conversation here. But Gareth, this is your first time on the CEO barbecue, so I'm afraid some grilling is in order, starting with a fan favorite question. Who are you and why should I trust you with my money?
Thanks, Antonio. I look forward to it. It's good to be looking forward to being grilled. My name's Gareth, as you mentioned there. I'm the president, CEO, and founder of Westhaven Gold back in 2010. And I've been involved in this mining space for quite a long time, actually. My father, who was also a founding director of Westhaven, is a mining engineer and spent a lot of his career up north in the Northwest Territories, Nunavut. My sister, who is now our chairperson, Ira, is a geologist, and I spent a lot of my younger years. I think I had my full first summer job when I was 14, working up in the middle of nowhere with the bugs and the animals. And I think I got a real desire for working in this sort of business, though I've done some other things between when I was younger, trying to figure out what I was doing. But yeah, needless to say, I'm back into this business and I love it. It's certainly full of ups and downs, but we're pretty excited about where Westhaven is now on the Spence's Bridge Gold Belt in southwestern British Columbia.
What were the last 3 companies you were involved with? You said you'd been involved with junior mining for a while now.
Yeah, company right before Westhaven was a company called Staccato Gold, where I worked there for just under 4 years, between 2007 to 2010, excuse me, where we actually had a friendly takeover there, which I was a part of. And yeah, that was based gold property down in Eureka, Nevada. And prior to that, I was with the group called Impact Silver, where I did some investor relations work there. That was kind of my first real step into the business from the field. And prior to that, I worked with a group called Stornoway Diamonds, which my sister was a big part of there, and a group called Strongbow Exploration as well, which is now transferred to Cornish Metals in Cornwall, UK. And prior to that, worked with many other juniors here and there, and lots of work in the field prior to that as well.
And currently, Westhaven is your only venture? Because I looked at your SEDI filings, and that's the only thing I could find. But is that the only thing you're doing right now?
That's correct. Yeah, publicly, that's the only company I'm involved in. Yes.
Is there, when you say you're kind of getting me intrigued because you kind of hammered in on publicly, which might mean that you're doing some stuff privately. Are you doing what I care about the most here? Is there like a drilling company or a helicopter company or something else that you're privately involved with that currently services Westhaven?
Nothing on in the mining space. I'm just a shareholder of a paving company and a asphalt recycling company that have nothing to do with the day to day. I'm just a more or less a shareholder.
Right. And there's no connection between Westhaven either, like the Westhaven is not working with any of those companies?
No, No, nothing to do with it. Completely separate. But yeah, so yeah, nothing. And I'm not involved in any other venture outside of Westhaven.
Mm. The directors and officers are noted at 20% ownership, as I mentioned earlier. What part of that is you personally, and what's your average cost of capital?
I've been the founder here from 2010. And I've taken part in some financings along the way as well. I own about 4.5 million shares, I'd say, and average cost. That's a good question. I've never sold a share for one, which is 13, 14 years here. I know there's some, but average cost, I'd say probably somewhere in the 15 cent range.
So basically, where we are at right now. Why I'm asking you that, I don't need a specific number here, but
Yeah, yeah.
what I care about is mostly stuff like founders shares. I mean, and I obviously want you to have skin in the game and be aligned with me mostly because if you have a one a penny paper, for example, if you have something along those lines, then how aligned are we? But you seem, again, I looked at your SEDI filings, you didn't have not sold shares, and then you seem to be buying along the way too. Do you invest in other companies yourself on the publicly on the venture exchange?
Yeah.
Yeah.
Oh, well, just before that, Antonio, I'll just clarify there in terms of founders shares, which I think is actually not brought up much before, which is a very good point. You brought it up. In fact, we received no shares. We did our founding offering at 5 cents we raised 500,000 amongst us, four founders, directors at 5 cents, and the IPO was at 10 cents. Just for full clarity there, we've never done penny, sub penny, which some groups do, and I think that's a good thing to clarify there, as it's often not brought up going back that far, but I think it's an important point you make there for sure.
Good.
Yeah,
Well,
and
thanks for
then,
that clarification. To go back to
yeah,
the
yeah,
question that I asked,
yeah.
do you do something else with your money, like in a venture exchange, or just anything else that you do in the public markets?
Sure. To be frank, I'm pretty much at this point, pretty much all in on Westhaven. I don't have a lot of extra capital at the moment. I mean, we do um, some obviously more investing versus speculating on some other things. Obviously, I have some more conservative accounts, but yeah, I don't do a lot of investing outside of. I have before. Don't get me wrong. I've dabbled in a few things, but at this point, I'm sort of all in on Westhaven's what we have here and what money I put into Westhaven.
What percentage of your portfolio would you say is exposed to Westhaven if you account for the other conservative stuff, is what you call it?
Oh gosh. Yeah, I mean this is a really good grilling. You're now making me think more for a Monday than I would have liked. I'd say probably well over 50% is in Westhaven for sure. I guess I could go into more specifics, but I'd probably leave it there. Yeah, a lot of I'm certainly it's been a pretty rocky junior mining the last few years, or you could argue many more years than that. And I think we're finally seeing something here, but it hasn't been. I mean, I remember back in 2007, obviously a much different time where, companies with moose pasture, when you asked if I invest in other things, and I'd say, well, this looks like it's going, and you'd make, that's when everything was going up. But yeah, nowadays you got to be obviously a lot more selective, and I feel Westhaven has all the uh, certainly all the ingredients, and that's where I am. Nothing comes to mind other than Westhaven at the moment for this sort of space.
Hmm. Well, calling the period here rocky is actually putting it mildly. It's being crazy. What about do you or any of the other team members own any royalties on the project personally? Any of the founding fathers, if you will, and mothers, I suppose. But yeah, do you guys own any royalties on the projects?
No, no, we own nothing personally in terms of royalties.
Hmm. Good. This is actually part of my smell test before I get into the actual barbecue here. But
I like it.
high level maybe before we get into the specifics, which I hope we will later on. What's the main unanswered question here for Westhaven right now? What's the next step the answer to which you think could result in an increase in the share price?
Yeah, I think the market, as always, with these types of stocks, and especially ours, and I don't like to go back and harp on the old cliche, you're only as good as your last drill hole, but that certainly, we certainly came out with a bang in 2018. Though we'd been drilling prior to 2018, we hadn't really had the capital to really go at this. So when we made that big discovery in 2018, people are expecting for the next, this is, it's going to be consistent drill intercepts of 400 plus gram meters. And I think we've done a very good job proving up new zones of interest here. But for us, it's really finding, to answer your question a bit long-windedly there, is to find more of these south zones, which we discovered in 2018. We've discovered FMN since then, Franz, and that's what we're doing as we speak, drilling up on Shovel Nose and really looking for that next south zone. And I think, we may get into the south zone PEA a little bit, but backstopping at 1,800 gold, 222 million dollar NPV there. It certainly is something to backstop on, but we think there's going to be a lot more of these south zones, especially along this 11-kilometer, what we think is mineralized corridor, and we're drilling 6 kilometers from there as we speak on this newly discovered Certes zone. So you mentioned there earlier, I don't know if it was off camera, Antonio, just or maybe it was when you first talked there about these epithermal systems. They can be, like much exploration. I'm not just saying epithermals, but they can be challenging and take a bit of time and sleuthing to really find more. But we see all the hallmarks of a very strong epithermal system here, and we're not the only ones that think that. There's been numerous groups up here, numerous epithermal experts, and they all kind of see what we think is there's going to be a lot more of these. It just takes a bit more time, I think, than where as an example, as maybe a porphyry target, you have a much bigger area, and you can kind of and I'm not saying by any means they're easier to find or discover, but I think finding these smaller high grade veins can certainly be more time consuming. But I think we have a really good how we go about our exploration process is very good, and I think we're unearthing more. We're going to unearth a lot more of these things.
You bring a couple of good points here, Garrett, that we should talk about later on, especially the geological stuff around the epithermal veins that you're bringing up, as well as the people who tried it before. But to go back to something you said there about the PE backstopping the valuation, that's something I've been wondering about with some of the smaller companies out there. Does it backstop the valuation, or does it put kind of a ceiling on you thinking, oh, they have a PA, that's the PA, that's what we're going to value it at right now? Maybe in good markets, it puts up a backstop. In bad markets, maybe it puts up a ceiling. And so what do you think solves that is essentially what you're telling me here is find another south zone. But what do you think the magnitude of the market's reaction could be if you did find that south zone? If you answered that unanswered question positively, as in, what's a company worth that has 2 south zones instead of one? Is it just double your market cap right now? Do you kind of blow off the ceiling that potentially the PA has put on you, or how do you see it?
It's another excellent point you bring up there, a question about the ceiling versus, and I think at first when we did the PA, which there's obviously even amongst our management and upper management was, do we do a PEA? A lot of groups are being sold for no PEAs or no resources, and we're saying, like you just said, is it a ceiling or is it a backstop? And I think that's very important to know, especially this is going to be a mine one day. I guarantee you. It's just what size will be us. We're obviously moving ahead proactively with doing the environmental baseline work. We're setting this up for a potential suitor or ourselves, moving it forward. But that's an excellent point. I think your question was if you find another south zone. I think certainly where we're drilling right now, 6 kilometers away from here, where some people think, oh, that's an aggressive step out. But obviously we see evidence to why we like that area 6 kilometers away. But this trend, which we can touch on here later, I'll just answer your question. I think the ceiling could certainly blow out here if we were able to find another cell zone like, or just another, highly in mineralized vein system somewhere else besides the cell zone. And I think we've proven that, but I think the market's really wants to see something, outside of the cell zone, and there could be another one within a few hundred meters. You look at Fruta del Norte in Ecuador, 20 years after their discovery, they just found another major, won't call it deposit quite yet, but another multi-million ounce 2 kilometers away from their main zone. So these things, there's lots of evidence of these things that sometimes they're tricky to find. And but to answer your question once again, long-windedly, yes, I think this would certainly hitting something high grade here would be great, and just not even something high grade to show people that we're hitting a system elsewhere, not necessarily along this 4 kilometer trend where we've spent a lot of our work. Well, we've done a lot of our work the past 4 or 5 years. I think if we can prove something that we're onto something elsewhere, I think that would do a lot for the confidence. And yeah, that's of course, do we want to tag into another cell zone? Of course. And I think it's just a matter of time.
You mentioned a couple of years here, 5, 6 years, and you mentioned earlier that you've been at this for what, almost 15 years now. How long is it going to take you to answer that question, albeit positively or negatively from here on out? Like, are we on the cusp of that, or does it take you 2, 3 years more?
Yeah, I mean, going back to 2011 when we went public, our first drill program was late 2011. I think we got to go back and look at that. That was a total 7 drill hole program, a total of 690 meters. You got to put that in perspective. We've drilled holes that deep now. So I think it's certainly a good point you bring up because it seems like a long time, but we drilled from 2011 to 2018 prior to the big discovery. I think we drilled a total of something like 10,000 meters. And then in 2020, 2021, and 2022, we averaged 40,000 meters a year. We drilled 120,000 meters in those 3 years. So back when the market was quite bad between 2011 and 2018, we were sort of, didn't have a big team either. So we didn't have a big geological team out boots on ground, which we're doing now, able, trying to find more of these things. It was more, hey, we can scrounge together a bit of money here and, drill test some of these things. But every program, I think the good point here is that every program we were seeing more and more, which sort of encouraged us, but it was just the market and the money, cost of capital to try and to get the money. And I should say on that note, Antonio, you mentioned there at the top there, we have 188 million shares outstanding, and of course, of which about 30 of that just came from this new financing we did. But prior to that, this is from 2011. We've never done a rollback. We've been very cognizant of our share structure. So, yeah, I mean, it's the cost of capital where it can be, obviously I'm not the only one here in terms of this junior space can be challenging. But yeah, to answer your question, I think we're well on to finding something off this, as I mentioned, off that 4 kilometer trend from South Zone to Franz, if you will, and what we're drilling now. But I think we're able to process that a lot, what we're onto much quicker now with we have more of a technical team. We're doing a lot of boots on ground stuff. And I think just from our experience and looking at some of these targets, it certainly helps how we proceed on our next targets. And I think just really it's what we're learning here as we go along with Peter and Robin and the technical team. It's a lot less trial and error. I think we're finding out as we go along here what's working better and what doesn't work as well.
Well, finding that out, how long is that going to take? I mean, if you go now on this field program and maybe it isn't there, but how long is it going to take you in the back of that to find out where it is? Like, do you need to just, drill now or do the assays now, see where it's not, and then knowing where it's not, then you know where it is and you go and find it next year? Or does it take longer than that to figure it out?
Yeah, I mean that's a good question. I think if we all knew the answer to that I think we'd be in a different conversation here. But I think importantly, we realize we have to attack this more aggressively. We have a 650 drill hole permit, which we received last year. So our permits are there. And I think now, and just talking about the cost of capital again, I think we realize that, obviously in this market, we're near around, pretty low here in terms of our share price. And what's the cost of capital? What's the dilution to raise the money? We could spend, I think we could use, 10 to $15 million here next year alone to test out some of these targets we like. So I think we're, as a company, as a management here, we're looking for, in the past, we've been adamant about not, doing an option, joint ventures, any sort of, we thought it was best to keep these 100% held. But I think now, if the potential is there to get a partner that can add not just money, but I think experience and expertise in helping us grow this, I think, what's best for our shareholders. And I think that's something we certainly have to look at. It's tough diluting at these prices. I think everyone would agree. Of course, the market seems like it's, even the bottom here looks like it's starting to percolate. It has for a while, especially gold. Obviously gold's very healthy, but is that disconnect going to narrow here? I sure hope so. But we are looking at, other avenues to expedite this and find things. So I think your question is more of a, if we had the cash and the ability, I think our permitting's there. It's like we need to fast track this, and what's the best way to do that? So I think, yeah, we all want to get this, find out what we have here as quick as possible. So I hope that answers your question in a way that we, if there's an opportunity there for, for someone to come in with some ideas, not just ideas, well, money ideas, and we'll certainly look at those.
Well, but and cash is part of that too. And this is another crystal ball question, I suppose. But to the best of your abilities, what do you think it's going to cost you to go and find another South Zone? If you had unlimited capital and you could just spend it, how much money do you think you have to spend to find another one?
That's another very good question, and I like the crystal ball reference there because, yeah, that would be a nice thing to have. But you know what? I put it this way: I think we're on the verge of something as we speak. So I think it's, of course, I think even in our past, going out to, look, update people on our presentations when we're raising money and stuff. I think it's important to tone people's expectations on what a success is. But I think we're certainly liking what we're in terms of what we're targeting right now. We're certainly excited about that, and yeah, I think we're certainly like where we're at right now in terms of where we're drilling and testing. I think we're starting to see things, the hallmark ingredients of a potential another system, kilometers away. So, but to answer, I mean, it's a tough one to answer in terms of the crystal ball, money. If money's not, how long does it take? It's a really tough one to say, but I think we have dozens of drill targets for next year, and it's just how do we get to those without diluting our current shareholders and making the best opportunity to find these things as quick as possible. So it's a bit of a runaround answer there, but it's a tough one to answer when you don't have a crystal ball.
What about permits then in that case? First Nations relationships and all that, birds and fishes, and do you have to go through more paperwork before you can actually get to some of those dozen targets that you're talking about?
Yeah, that's an excellent question, and one where yeah, so just a little bit on the process of, yeah, we have those 650 drill hole permit which we received last year. It took obviously working closely with the nations in the area, and the process now is anywhere you drill. Some places are different in BC. I just know our particular area, being here for many years and working closely with the nations who do our preliminary field reconnaissance surveys. So they got to come out. They'll come out and look at any area we're looking to drill. So we'll give them those locations. They'll come out. They'll do a preliminary field reconnaissance survey. Then in certain times of the year, I should know that off the top of my head. I think it's around April to August. Then they'll have to perform a bird survey. and then they'll come out and to make sure there's no nests. If not, we have a week to clear that vegetation and get the drill pad sort of ready to go. So that's the process there. So, and of course, we're proactively getting these PFRs done. So we have many PFRs, and yes, many of the targets we're looking at now have been PFR'd, but we're always getting things done when we have other ideas. We've had many people in the field this year prospecting, sampling, mapping, and finding new areas of interest. And we'll be quickly get groups out there to look at that ground and okay it for further exploration is kind of where we're at. I also should note, Antonio, we reclaim all our drill pads, trenches almost immediately. We can't have more than 12 pads left unreclaimed until if we're drilling another one. So we can never leave more than 12 pads unreclaimed. So it's a very good process in terms of it's good for everybody where it keeps the ground looking I think it looks very good up there. So yeah.
In asking you that question here, Gareth, I was not trying to steer away from the timing, but more to better understand. So this does help. And you're not the first one trying your hand at this project. BC has been looked at many times, and again, you've been at it 15 years now, but you cannot have it being another 15 years before you find another south zone, or the market is not going to be happy with that. What are you doing differently than what has been done here before? What are you doing now differently than what you did at the beginning that would kind of speed up that process?
Yeah, well, I should just clarify. We are the first one on this property to drill. We are the first group here. Yeah, we're in the Spence's Bridge Gold Belt, and um, there was some work done in the early 2000s, but Shovel Nose itself, we were the first ones to drill here. So it is really kind of uncharted territory in a way. And I think that in a roundabout way, I think that might be some people in their way of thinking saying there's not a mine really on this belt, this Cretaceous gold belt. You mentioned at the top of the show there, the Hudbay, Teck, New Afton, but those are actually on the Nicola volcanics, which is a completely different geology to this Cretaceous Spence's Bridge gold belt. It's quite a bit different there. So yeah, we really are the frontiers on this gold belt. So it is a little bit of a lot more trial and error than people think. But at the same time, it's an epithermal system, low sulfidation. Peter Fischel, our exploration manager, spent 12 years at Kupol working on another Cretaceous low sulfidation epithermal project. So I think we certainly have the right group here. It just can take a bit of time. But yes, of course, we don't want to go another 15 years to find another south zone. But like I said, I think those earlier years, the first 7 years working on this project, we weren't able to do a whole lot of work on it. I think that certainly changed here in the last few years here. But yeah, we're doing everything we can, throwing everything at this in terms of, as mentioned, geophysics, mapping, prospecting, a lot of boots on ground this year, and of course drill testing. And I think we're certainly onto something that we're excited about.
You did have Franco Nevada excited about the story too at one point a few years back. How's that relationship now? I've heard or read less and less about it in your news releases. So how come? And what are they telling you about how excited they are here?
Yeah, and I think that's Franco being obviously a very much larger cap company. They don't usually, as far as I know, I mean, I don't quote me, but they don't usually take buy royalties for something that's not as advanced or sorry, certainly not as developed. And they were in here, our pre-PEA investing. It was a $10 million financing package in late 2022 prior to our PEA. So that was a big stamp of approval for us, having a group like Franco recognize this, saying, hey, not just the shovel nose itself, but I think they've had some of their team up to site. I think they really see the potential of this, not just shovel nose as I mentioned, but the Spence's Bridge Gold Belt. And since then, I believe they did a deal with Well, no, I shouldn't. Maybe they haven't, but yeah, I think it's just a big stamp of approval for a group like them who are usually getting into more advanced projects. I think something like ours, it was just and to ask where they're at today, they're still shareholder, and we're still in touch. We met with them not too long ago just to give them updates and stuff. So yeah, they're still a shareholder, and yeah, we're happy to have that stamp of approval.
They haven't they didn't keep financing you on some of these private placements that you've done in the meantime, if I'm not mistaken, though. So when I ask about what are they telling you, I'm asking, but how come? And what are you telling me about that? And maybe is there something that you can do, get them back, or get increase their interest, get them back to participating in your private placements, or even to interest another major into coming in as a JV partner or a strategic investor? Because again, and this is all in talking about how much money it's going to cost, the answer to which is not entirely clear, but it's probably a lot, right? So getting a major or just a big company to finance you or get in for or come in for a JV can be handy, or it could be really life-saving here. So yeah, I mean, talk to me about that. I know there's a lot of questions in there in what I said there, but talk to me about that. How do you get a major party interested, and is that part of your strategy?
Yeah, and we've had many groups through ever since we made the discovery. Just a lot of due diligence on their behalf. Obviously, I think most major discoveries will get groups in coming to look at their as many as possible. So yeah, we've had many groups up the site, CAs signed. I think the big thing, and I'm happy you asked this question, Antonio, because I think a big thing there is prior to really this year, we were adamant, it was just the board mandate. We were adamant about not doing joint ventures. We just didn't feel it was, we've seen some rec companies like ours in the past. So I think joint ventures weren't really on on the menu. I think now we've changed that, as you mentioned, just with the cost of capital, because we could spend uh we could spend $50 million here really quickly, I think, to as talking before, to expedite this, to find out what we have here quickly. So I think we are certainly when we talk to groups, we're certainly more interested. Like I said, though, it's not just about a check. I think it's about the group that's going to help us move forward and help benefit the area, the nations, the group. So and maybe potentially be able to be a suitor. So I think it's there's many groups out there, but I think trying to get the correct one for this potential project area is important. But yes, we are certainly, as mentioned there, we're open to more of partnership now.
Do you have? I understand I'm asking a crystal ball question, so maybe you should have brought your crystal ball here. But do you have an idea of when that might happen? Like, is that a 2025 thing, or is that something that happens way down the road?
Yeah, I'd say it's something in the more near future for sure. I mean, there's a lot of moving parts on these things. Don't get me wrong, and I will say we have had JV um, offers in the past, like I said, where it just wasn't in our mandate at the time for various reasons. But yeah, I think it's something we're actively discussing. So yes, I think it would be much more of a near term something for 2025 would be we've spent sitting here what 20 plus million market cap, spent 50 million on this project. We have I think a great, like I said, going to be a mine there at South Zone, but there's going to be more of these to unearth. And I think now, I think you're alluding to here, Antonio, and part of the grilling here is it going to take that, you know, is it going to take another 15 years to get there? And the answer to us is no, we don't see that. We want to do this quick, and in order to do that, we're going to need capital. So I think and we're telling people as anyone we speak with, update shareholders, current shareholders. I think that's something we're certainly, being more. I won't say open. It was never closed. It's just if it's the right group, I think it's something we'd look at for sure.
What would it take, and who's the right group? Like, if I'm doing a lot of hypotheticals here, but if I came to you tomorrow and I said, Garrett, I work with this company, whatever, Franco, whoever else it might be, I mean, tech, whoever else it might be, and I'm like, let's do a deal on this. What do you want? What do you want to see on the table from me?
I think it would be I think we can all see it would have to be a fairly large first, maybe 2 years, but certainly a year or two, it would be have to be a pretty large sum of money up front, I think, to prove uh, for us to test these areas to say, hey, is it here or is it not? At least in these targets I mentioned, where we have dozens of targets here, to test those in the first year would be a big spend. It would have to be, a big spend to really test what's there, and then there's an opportunity to obviously earn. We haven't looked at the potential earning scenario or how that all works, but I think it's amongst our group, we're all pretty adamant it's got to be a big first year spend, and maybe the first 3 years you put a number on that. But I think, as you mentioned there, I think people, we included as big shareholders, we want to find out what we have here quick and or as fast as possible. You can't always go quick. You got to wait. You're always waiting for things, assays for results. It's not always as quick as you want it to be, but I think now we realize we want to get expedite this as mentioned. So yeah, I think the one big thing is, without saying too much in terms of what we're as we don't know, but I think it would be a big definitely first year or two spend. A serious group who wants to grow with us as quick as possible. That's probably the best way to say it.
Mm. If we get into the realm of speculation and kind of gut feeling and what you think is going to happen, not what you're committing to, but just what, you're in the shower, you're thinking about, oh, if I could just get that group in, who's that group? Who do you think this fits with? Like this kind of asset, this part of the world, there's really not that many potential suitors. The list is not endless. So who do you think it fits with?
Yeah, and that's a good question. I'm not going to obviously name any potentials suitors, but I think it's an excellent point, because you're not going to, especially with what we just with the appetite for, say, the majors. A lot of them are looking for 250,000 ounces a year of production. That's something we're not going to have, especially with just the South Zone. But I think you're looking at a mid-tier group who's maybe looking to get out of a bad jurisdiction somewhere. Well, I won't even speculate as to where that could be, but there's many groups looking for projects in Canada, namely BC. They like jurisdiction. I think it's a great place to be, as long as you're spending the time and efforts amongst the locals and the nations. I think it's a great place to be. So I think it's people, are groups that are more and ones that I think have an epithermal appetite and see the potential. Ones who've come to site, looked at the core, and said, "Yes, this is a powerful system. This is a big system," and we've seen those groups. And I think it's a matter of them seeing what our PEA is, 65,000 ounces a year for 9.5 years. They see the potential to double that, and obviously, with our FMN Franz, there's certainly more ounces there. So yeah, I think it's going to be your more mid tier. If that answers your question a little bit, I don't think you're going to see the the big few that are left. I should say a lot of them are being sort of amalgamating, but yeah, I think it's going to be that more mid tier who sees the potential to grow, just not the South Zone, but grow it here, or potentially someone who wants to start production at the South Zone. It's a very especially today at what, 2,700 plus dollars gold, and I don't even know, what are we at silver today, Antonio?
Hmm.
I haven't even looked at silver, but I mean, um, yeah, this our South Zone's grown, exponentially from even the gold price that we did at 1,800. So it's high margin. So I think there's going to be a lot of potential suitors. I think we just got to, um, choose the right one who we can see growing this with.
Let's I know time is kind of pushing here for you, Gareth, as well, and I want to talk about some of the specifics. So let's maybe talk about some of the specifics and tie it into what we just talked about here. You're dealing with low sulfidation epithermal vein system. You're mentioning going into production here on the South Zone, which has a PA on it, although it does need more drilling to get it into an M&I, I suppose. But the veins on those type of systems can sometimes, obviously, first of all, pitch and swell, but second, and maybe more importantly, they can be sporadically distributed. across the land package, resulting in, again, serious grade variability between different holes. And with you specifically, while you do have some bonanza hits, again, they're highly localized, and again, what looks to me to be sporadically concentrated. So with the currently ongoing drilling, how do you deal with that, and potentially getting into a mining scenario? What do you have to do, or what can you do now in order to deal with all that?
Yeah, no, another good question there. In terms of the south zone, just back to the actual veining there, um it's a great looking. I mean, we have it on our website for any of your listeners there. They can go check out. We have a verified model of it's a nice looking model and how that's going to be mined. And I think people certainly see that as a small footprint underground deposit. And um, yeah, but finding that, I guess to answer your question there, to finding that the south zone, it it's as seen when you mentioned pinching and swelling, but discovering that was took a lot of I'd say all hands on deck, but using a lot of these different tools from magnetics to induce polarization. But it came down to really our technical group being able to recognize where we were in the system, as these systems can be very challenging to see where you are in regards to where part of the system are you on? Has it been eroded? So finding that type of looking in there and seeing the rocks to know where you are. And I think if it was as simple as us taking an analog of the south zone, which of course we've done, we've looked at what worked for us to find this, then of course transfer it to different areas to say, hey, where's that south zone? But none of these, you can talk to anybody in well, many geologists, but even epithermal geologists, no two of these are alike. And I think at first we were a little bit, at least I was naive in a way, thinking, oh gosh, there's going to be so many more of these. And of course, then we hit FMN in 2022, the 23 meters of 37 grams. You're going, oh, this is great. We're hitting more of these. But as exactly what you just said, these things pinch and swell, they fault off. They just are more, and nobody likes. I've even heard people say you're not supposed to talk negatively about the challenge of finding these, but it is. It's a challenge. It takes time. It takes patience, but they also take money. And if you had an endless supply of money, I think as we were talking there about potentially getting getting an avenue to get more cash here and find things quicker. That's something we're going to look at. I think that benefits our shareholders more than anything, but the importance of being able to test these, it's really comes down to drilling. Of course, finding things on surface, but it's drilling. It's you got to be able to test these things. South Zone was 100 meters under overburden, so to put that in perspective, there was really not much for signatures on top of there. There wasn't a big gold signature saying drill here. It was a combination of different tools for us to get there. So it's but we certainly have, I think, the group and the tools now to find more of these things.
I do like talking about challenges because it just gives a real idea of the exploration process, which isn't always just flowers and that's actually most of the time it isn't flowers and roses. Well, what is the main challenge? Is that the main challenge that you're solving here then? Because as far as I understand, again, correct me if I'm wrong, but just it's predicting and modeling veins, and specifically their orientation and structures at shovel nose. That it isn't all that easy because of the overlapping cross-cutting veins, essentially making it harder for you to pull out a non-dry hole as predictably as you could if this was, again, you mentioned porphyries earlier. So again, I mean, is that the main challenge? Is there something else keeping you up at night? Is there something that if I gave you a magic stick and you could just wave it at the challenge, make it go away, what is something else you'd wave it at?
Yeah, that's a tough one to say in terms of a magic wand. Obviously, it'd be where these things hiding. I think the some people consider there's not a ton of, though there's rock exposure, there's not, we don't have a ton of area on the property where we actually see. Franz is a very unique spot where we have an outcrop on surface where we have uh you know sitting right there on surface, which is pretty rare anywhere in the world to see an outcrop like Franz where you're getting up to 200 grams per ton gold sitting there. And but that's rare. When people come up, they see that, they go, "Oh, this is awesome." The majority of the property is very limited exposure in terms of rock, so it's not always easy to see So we've done, we do a lot of LiDAR imagery in terms of uh, we're actually flying one on our new claims here starting soon. It gives you a really good idea of what's underneath that tree cover. It's the light system where it penetrates and allows you to see what we perceive as faults and what's happening on the ground without all the vegetation. So it's a good way to use that because yeah, it's obviously treed in places and not a ton of rock. So like I said, the best thing we've done in the last 2 years, I'd say we've taken our foot off the gas a little bit on the drilling. We've only really used one, though we continued on drilling, where you really only just using one rig, and that's um, that's enabled us to get the more of a team geologist out on the ground, including Prospect Valley, which you mentioned earlier as well, but getting those boots on ground to go and look at what's on surface. A lot of areas we've some people have been over, looked around, but the more boots on ground we get out there, the more things we unearth and find for drill targets. So, and of course, that's not a going out there and finding something. It could take months to actually turn into a drill target from discovery. So, yeah, it's time.
Yeah, and I understand that part, Garrett. Thank you for going over it with me. How's the current drilling that you have, those 4,000 meters that I mentioned that you started in what, August? Been a while now since we've heard something about it. How's that going? Any challenges? When are we going to hear something about that?
Yeah, we'll have some news out fairly shortly here on the program. Yeah, it started there in late August. So yeah, we're due for an update on that. Um, yeah, it's going well. I think we'll have steady news flow, I think, as we start to get results in from that late August. So will be coming up soon as well. So yeah, we'll have a good flow of news coming out from now until till Christmas time and into the new year. But yeah, I think we're you know optimistic about the current drill program for sure.
Well, let's hopefully stay in touch in the meantime and see what happens. There's a couple of more things I wanted to go through, but I understand our time for today is over. So thank you so much for investing your time in me, Garrett, and hopefully speak soon.
Yes, thanks, Antonio. I look forward to doing it again. We can finish off at some point. Thank you.